We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more, but
that's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Welcome back to Bloomberg Markets. I'm Danny Berger in London. U.S. markets are closed for the Thanksgiving Day holiday, so we have very light volume. You have cash equities in the U.S. and Treasuries closed, but futures are up and trading. Japan markets also closed for the Labor Thanksgiving holiday. Bond futures just ticking lower in the past 30 minutes. The move was lower yesterday off the back of some more hawkish type data on very thin volumes. Euro, that's strengthening thanks to PMI data in Germany that came in above expectations. You have the same happen for the UK, too. That data came in above expectations, fueling also sterling to move higher. Brent crude drops for its second consecutive day. It ended down more than 1.5% yesterday. Today, it is down about 1%. It is the delay of the OPEC Plus meeting. It was scheduled to happen this weekend. Is there a discord over supply cuts? What does that mean at a time when non-OPEC Plus supply is swelling? In this equity market, what a strong November it is shaped up to be. We're not far from double digits returns, as Jim Reed over at Deutsche Bank flagged. That's only happened twice in the past decade. The last one was November 2020 when there was some good news over vaccines. European equities struggled to hold on to any gains today, while MSCI Asia Pacific without Japan, again, a holiday there, is doing stronger, up about 1/3 thanks to China property measures. And we did speak to Laura Cooper in the past half hour, who said that they are turning more risk neutral from being risk adverse. At least in the short term, you want to move into some of the more risky assets like high yield, because there does seem to be appetite there. So yesterday, we got a couple bits of data. All of it did turn into a session where you had the front end of the curve in the U.S. move about 5 basis points higher. It's been a big dovish run in November, and some of it started to come back. This was the real piece of data that you started to see a change. It is University of Michigan. We have the final reading on it, and short-term inflation expectations are at a 7-month high. In the longer run, prices expectations are at a 2011 high. So that curbed some of the cut and some of the dovish enthusiasm. Let's bring in now Nicola, my sovereign credit analyst at PIMCO. Nicola, if you look at something like that, and it had the reaction, I know, on thinner volume heading into Thanksgiving of a sell-off in treasuries, has the dovish run, has the rally throughout this bond market just gone too far?
I don't think it's gone too far. I mean, if you look at the U.S. Treasury notes, yielding 4.4%, implied in that there is a real rate in the above 2%, between 2 and 2.25%. I think that's a pretty healthy real rate that investors can earn on a U.S. Treasury note, especially if you take the view, like us at PIMCO, that the neutral rate, that the equilibrium rates in the economy have not changed substantially over the past few years. And, we think equilibrium rates in the U.S. remain pretty low in the 0 to 1% area. Now, in the near term, there is a decent amount of rate cuts priced in already for central banks, like for the Fed, almost 100 basis points for next year, similar for the ECB. So I wouldn't bet necessarily on more cuts than what's priced in the market. But if I look at the curve as a whole, I think there's still value in duration.
Well, will you say that the market's not pricing in enough recession expectations? So does 100 basis points of cuts reflect a recession in that case?
No, I think the market is pricing what you could call an immaculate disinflation scenario where growth remains pretty solid and inflation falls nevertheless to target. We would take a different view. I mean, we think that what has been supporting growth is a fiscal sugar rush, which looks set to fade. And we also think the impact of monetary tightening will accumulate and will be felt in 2024. So I think if you look at risk assets, be it equity markets or credit spreads, I think they are signaling a pretty benign economic outlook, and we would probably be more cautious than that.
Okay, so that makes sense, and you would be more cautious on some of that riskier outlook. But can you kind of define what type of downturn you're exactly looking for? Because we've kind of lost the meaning of soft landing, hard landing, no landing. Honestly, Nicola, none of it makes any sense anymore. What exactly are you expecting for 2024?
So for 2024, I mean, we expect a sort of mild recession type environment between stagnation and mild recession. So a U.S. economy that has been growing at a very healthy pace, shifting down towards 0% or slightly negative growth as we go into 2024. Now, that's not a deep recession, but it is still a recessionary type environment. I mean, remember that whenever the unemployment rate rose on a sustained basis by more than 0.5 percentage point in the past, the so-called SAM rule would, suggests that at that point, normally a recession has been called by the NBER. So that, we think the unemployment rate will rise from here, and that will be a recessionary type environment. Now, there are risks of a deeper downturn. The reason why... Yeah, go ahead, sorry.
Yeah, sorry, go ahead, Nicola. What are the risks then, the deeper downturn?
I mean, there is a risk of a deeper downturn, of course, because often we don't know when there is a sharp tightening cycle like the one we've seen, something breaks in the financial system. And there are some areas of weakness, among which commercial real estate, some areas of the private markets that we're watching closely. Now, the deep downturn is not our central expectation because corporate and household balance sheets start from a fairly healthy position. B, financial stability policymakers have been very active. So whenever there was the risk of a breakage, generally speaking, we had an intervention by policymakers. So it's not our expectation, but we need to be prepared.
Nicola, It all squares with your view on perhaps high yield spreads have come in too much. And in this most recent rally, high yield and IG have come in even more. Now, Morgan Stanley estimates that the default rate on junk bonds is likely to peak at about 5% in the second quarter. Where do you see this default cycle going? Does something like 5% for junk bonds sound about right to you?
I mean, I don't have a precise level in mind. What appears to me the case is that credit spreads, especially in the higher risk parts of the market, like high yield, they seem quite compressed relative to what we should expect economically. But the point I would make also is that it's not just about the realized defaults being a lot higher than what's priced in, because often the market actually prices in more defaults than what actually happens. But it is the mark-to-market losses that you're subject to when credit spreads widen. So even if defaults ultimately don't end up being much higher than what the market is anticipating, I think, you know, from a mark-to-market perspective, the widening in credit spreads is something you want to protect yourself against in a weak economic environment.
Right, yeah. Yeah, especially considering where we are now. Nicola, thank you so much for joining us. That is PIMCO's Nicola Mai. Now let's turn to Europe, where far-right politician Geert Wilders has come first in the Dutch elections in a shock result that will resound across Europe. The Freedom Party leader will now have to forge an alliance in order to lead the country. Let's get over to Bloomberg's April Roach on this. April, how big of a surprise was this? What are kind of the takeaways from seeing Wilders come now to head up the Dutch government?
Hello, yes. So as you said, Geert Wilders' far-right populist party was the sort of surprise winner in the Dutch elections last night. And a late surge in the final days of the campaign saw Wilders' party rise to the top of the polls. And his party is anti-Muslim, has very tough policies, cracking down on immigration. And Wilders has also spoken out against sending so much aid to Ukraine. And his party is set to gain 37 seats, more than doubling the representation in previous governments, whereas we saw the Green Left Alliance led by Frans Timmermans coming in second place with just 25 seats, and the current ruling party, which is Mark Rutte's former party, gained just 24 seats. And I think that while we did see his sort of rise in recent days, I think that the wide margin win was quite a surprise.
And what will it look like now as a new government is attempted to be formed?
Yeah, so the Netherlands is a coalition country, and even though it's the biggest, Wilders' party has just about 25% of the vote. So in order for Geert Wilders to become Prime Minister of the Netherlands, he will need to form agreements with some of the rival parties, and those coalition discussions could take weeks or even months. So it could be some time before we know who will become the Prime Minister of the country, but it is usually the biggest party which takes the lead in those discussions. And also interesting to note that only once in recent Dutch history has the biggest party not become Prime Minister of the country.
Okay, April, thank you very much. That is Bloomberg's April Roach. Turning now to emerging markets, veteran EM investor Mark Mobius says dollarization would be provide a huge lift to Argentina's economy. He spoke earlier this week to Bloomberg's Kaylee Lyons and Guy Johnson.
If you go into a place like Argentina where there's inflation, we were investing at one point when it was about 2,000%, and it was very, very difficult. We had to buy companies on the basis of their book value rather than anything else. But at the end of the day, it's been a very dangerous place to be with the currency the way it is and with inflation in that situation. So now if they dollarize, that's a big if, by the way, if they go ahead with that, it will be an incredible boost for the economy and for the country. You'll see inflation come down dramatically. If they get rid of the central bank, that'll be another step in the right direction. And I think the outlook is terrific under these circumstances, but we have to wait and see if the new president can actually implement those changes.
Mark, good afternoon. Are there enough dollars to do that?
Yeah, there's plenty of dollars. It's not a matter of the quantity of dollars. It's a matter of pegging the economy to the US dollar, because Argentine people have lots of dollars offshore. you better believe that they protected themselves from this incredible inflation by having dollars. So there's plenty of dollars, and it's a psychological impact, which is so important. It's not a matter of them, using dollars every day with cash transactions. Nowadays, with paperless transactions, as long as you're pegged to the dollar and everything, all the prices are pegged to the dollar, then you're going to see an incredible return of confidence.
What about others? If you're looking at, say, China, for example, which has raised a lot of question marks in terms of the fragilities in that economy, the trajectory of it, is that somewhere you see opportunity or danger?
There are opportunities in China. It's a huge market, as you know. It's a big economy. But we think it's a better idea, if you want to look at China, look at it through Taiwan. Because you must remember, there's a lot of trade that takes place between Taiwan and China. Many Taiwanese companies are in China. Of course, Foxconn is probably the best example. Maybe not a good example at this stage of the game, but there are many, many companies like that. So we prefer to go into China through Taiwan.
Emerging markets investor Mark Mobius speaking earlier this week on Bloomberg. Coming up, the hostage deal between Israel and Hamas is facing a delay. We'll have the details for you on that next. This is Bloomberg.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Markets. I'm Danny Berger in London. Israeli officials have signaled that a release of hostages from Gaza and a pause in fighting would be delayed. Negotiations with Hamas are continuing. The 4-day pause in fighting and release of hostages had been slated to start today, but Israel now says that it won't happen before Friday. Bloomberg's Paul Wallace is in Dubai and joins us for more on this. Paul, why had this been delayed?
Hi, Danny. We don't think it's anything major, at least not to the extent that the deal is going to break down and not happen at all. We think it's just to do with all the complications surrounding this. It's not an easy deal. It essentially involves three elements. It involves the release of 50 hostages held by Hamas in Gaza, the release of about 150 Palestinians held in Israeli jails, and also the truce. And all those things have to come together. From what we're being told by Israeli officials, they have to happen at the same time, so we cannot have the truce before the hostages are released, for example. The latest from the Israelis and from Hamas is it won't happen before tomorrow. The expectation is, however, still that we will get a release of hostages and the start of fighting beginning tomorrow, Friday.
And of course, the U.S. President Biden has been very active in these talks, too. What exactly has his role been, especially as it kind of faces this road bump?
Yes, the U.S. was pretty deeply, very deeply involved in the talks that led to this deal being announced in the early hours of Wednesday morning. Qatar was the main mediator. It was dealing with Hamas and Israel, but President Biden said he was deeply appreciative of Qatar and Egypt, which helped too, and Israeli officials for getting this deal agreed to. Obviously, we still have to see it being implemented. Biden did warn, however, that it's very important we see all parts of the deal actually being carried out. And I think that underscored just how complex this is. When you just take, for example, take a look at the 50 hostages that are meant to be released, we don't know yet whether they're all going to be freed in one go or whether Hamas will do it in batches. So all this remains an open question, and it just highlights how complicated this is. And all the while, meanwhile, all the while, fighting continues in Gaza, and Hamas and Israeli forces are engaging in heavy battles in the north of the Strip.
Right, Netanyahu really cleared this week that a pause for the release of hostages would not mean an end to the war. Paul, thank you very much. That is Paul Wallace in Dubai. Now, coming up, we're going to bring you our interview with the Open Table CEO, Debbie Sue. Has everyone booked in their Christmas parties yet? This is Bloomberg.
Let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
From the world of politics to the world of business, Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Welcome back to Bloomberg Markets. I'm Danny Berger in London. As the holiday season ramps up, OpenTable CEO Debbie So sat down to speak with Bloomberg about the demand and dining trends.
We're seeing dining demand remain relatively flat year over year from 22 to 23. And I actually think that's incredible if you think about all of the macroeconomic uncertainty that we've seen this year, as you yourself have been reporting on. I think it's a win that restaurants are coming out relatively flat year over year, and it's a testament to how important restaurants are to all of us. So I think it's actually good. I wish it were higher, but we're seeing some really bullish signs for the holiday season that's coming up in December. Valentine's Day and Mother's Day were really high up year over year. We're expecting to see the same for the holidays in December.
Is this traditionally a time where we do see an uptick in people going out to restaurants? I know we kind of think of the holidays, at least here in the U.S., as kind of that time where we all spend with each other at home. But I don't know, depending on your family, sometimes it's a little bit better to go out.
People are definitely going out. And Romaine, you mentioned before the segment started that you're hosting this year, and maybe you want to save yourself some work and host at a restaurant. This is typically a very busy time for restaurants. Lots of restaurants do Thanksgiving meals. They host Thanksgiving meals, all of the year-end holiday parties leading up into right up to the first of the year, actually. We're expecting a big increase from a year-over-year standpoint. Restaurants' books are getting booked up, so if you haven't made your reservation, I would definitely go do that. But this is a big dining moment in the year.
So people are going out, and outside of just the holidays, as Romaine mentioned, people are going out alone. Talk to us about what we're seeing in solo dining, because I have to admit I was a little bit surprised to see that uptick there.
Yes, so solo dining has been up 4% year over year. It's the party size that has increased the most actually this year. And I think the reason we're seeing that is because there's been renewed focus on self-care, of dating yourself. I myself am based in San Francisco, and this Wednesday I happen to have a free block open, for lunch. I walked to Neiman Marcus and dined by myself at the Rotunda, and it was glorious. So I'm not terribly surprised to see this stat. I think more and more people are happy dining alone.
I wouldn't mind for a Thanksgiving dine out today. That's OpenTable CEO Debbie So speaking with Bloomberg's Romaine Bostick. Now, in other tech sagas, Sam Altman has been dominating the headlines all this week. We know the OpenAI founder was fired, then rehired in less than 5 days. Bloomberg's Alex Webb has been helping us track it all. Alex, is it over? Is the saga over now that he's back at OpenAI?
It's not the end. It's the beginning of the end, to borrow a phrase. He's back. It happened very quickly. It was like 5 days, Friday to Wednesday. But the thing that we're going to see now, it looks, reading the tea leaves, it's just a little bit more control from Microsoft, right? There are going to be more board members announced. I'm concerned about the diversity of the composition of the current board. The 3 men who've been appointed so far. Bloomberg has reported there could be 2 seats held on the board, looking for as many as 9 new directors. 2 of those could be Microsoft representatives. We don't know whether they will have a vote, but at least observers, because one of the things that Satya Nadella said is he didn't like surprises. He said there are problems with governance. That's what he told our colleague Emily Chang on Monday. So this sort of palace coup that looks to have been about preventing some of the direction of travel that Sam Altman seems to be taking the company in, chasing some money in order to fund these things, accelerating the pace of development, perhaps at the expense of safety. That's what some of the reporting seems to suggest. We don't 100% know that's true. This may have achieved the inverse effect, because the closer it is to Microsoft, the more it is going to be working towards Microsoft goals. Again, one important caveat, not saying that Microsoft is unsafe, but Microsoft is in the business of making money. That is not OpenAI's stated
Right,
intention.
very, very different structure. Alex, we only have about a minute, but just before this hour ends, I really just want to talk about the Thanksgiving Day box office. That's all I care about. It's Thanksgiving. I wish I was eating turkey somewhere, even though it's 10 a.m. We have this new Disney film, Wish, animated film. It seems like there's disappointment around what the box office is actually going to look like.
Look, there are three things here that are kicking in. There's the actors' strike, which meant that they couldn't really promote the film. Secondly, the film doesn't appear to be very good. It's not had very good reviews. There's a lot of criticism of the content on social media, laughing at some of the lyrics, that sort of thing. And thirdly, they might have been hoisted by their own petard, right? In previous years, in the past few years, they've been putting stuff straight onto streaming. That is particularly kids' animated films. People are not used now to going to the cinema as they were before. That might have reduced a little bit of enthusiasm for this kind of film.
Yeah, why go through the faff of hauling your kids into a movie theater when you can just wait a couple weeks and watch it? And the cost, yeah. Right. I mean, popcorn it's a ripoff these days. Alex, thank you very much for joining us. That is Alex Webb. Now, coming up in the next hour, I'm sticking around. You're not getting rid of me. We're going to be speaking with Ludovic Chabran, chief economist at Allianz, with some of those PMI numbers out in the past 2 hours. This is Bloomberg.
In billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
Good morning. I'm Danny Berger in London. Welcome to Bloomberg Markets. It's a special edition with U.S. markets closed for the Thanksgiving holiday. Here are our top stories. Property push. Country Garden leads China's developer higher after Beijing's biggest move yet to shore up the troubled sector. Far-right leader Geert Wilders secures a shocking win in the Dutch elections, promising a referendum on leaving the EU. And oil slides as discord within OPEC Plus forces the group to delay a crucial meeting. Now let's get to your market check. We should have a Turkey Central Bank decision just shortly. We don't have that yet. Oh, I lied. We have it, of course. Right as I say, we don't have it. So Turkey has raised their 1-week repo rate by 500 basis points. This is more than the market was expecting. It's now at 40%. The estimate was for 37.5%. So again, 500 basis points, more than the market was expecting. The expectation was that it would at least be above 36%, because that's where the expectation for year-end inflation in Turkey is. That means that for the first time in 2 years, the 1-week repo rate in Turkey is higher than the expected inflation. This is finally tighter policy. Off the back of that, the lira is extending gains on that bigger than forecast rate hike. And again, Turkey's central bank to slow down monetary tightening is some of the language coming out of this rate decision. Elsewhere, we also got a rate decision from Riksbank 2. They did the opposite thing. They held instead of moving, as many expected them to do. So that's a reaction in the lira. Elsewhere in markets, it is closed for cash trading in both treasuries and U.S. equities. The futures market is up in trading. Weakness in that 10-year bond future. Of course, volumes are extremely light, but some more hawkish data yesterday from the UMich inflation expectations to jobless claims that came in yesterday. At the same time, you're also looking at a euro that is stronger off the back of PMIs in Germany with strengthened more than expected. We're talking with our economist Jamie Rush, who expects some of this data to have really bottomed, or at least will bump along the bottom for the mean term. UK PMIs also stronger, looking at a stronger sterling this morning too, up about 0.4 versus the dollar. Brent, that's down about 1%. It's that OPEC plus delay. Now let's look at equities this morning. Again, the cash market will be closed today for the Thanksgiving Day holiday. If you're in the U.S. watching, maybe go help your friends make some stuffing or turkey. Besides that, U.S. futures are steady. It's been a really strong November. At the same time, we're also looking at retail investors buying up U.S. stocks. They're buying the most since April 2022. European futures more or less flat. And some of the property moves out of China helping to support Asia equities. Japan is offline for the Labor Thanksgiving holiday, but at the same time, Asia Pacific ex-Japan up about 1/3%. Now, more on that China news. Bloomberg has learned that China may allow banks to offer unsecured short-term loans to qualified developers for the first time. It's part of a package of new measures to backstop the real estate industry. Regulators are considering allowing banks to issue so-called working capital loans to some developers. This comes as Beijing embarks on a major push to ease the property crisis that's dragging down growth in the world's second largest economy. Joining us now is Bloomberg's Sofia Orta y Costa. Sophia, can you put this latest move on the unsecured loans just in context of what we have so far from China's support?
So it's the latest in a string of measures to really try to prop up the property market. But this one is targeted specifically at the biggest problem right now, which is how do developers actually get their funding? Because they used to rely on, of course, home sales, and they're not selling as many homes as before. There's a problem with confidence there, and it's unlikely to be resolved anytime soon. So what essentially this means is that if approved, this mechanism would allow developers to access funding, not from the bond market, not from the equity market, but actually from banks. So kind of shifting almost the responsibility away from the capital markets, where sentiment is incredibly low. If you're a developer right now trying to sell a bond or is trying to raise equity, good luck. But essentially, they can get bank loans without needing collateral. And this is incredibly important. And this is really, really big news because, it frees up capital, that kind of working capital for potentially, at least for them to finish their homes, but for potentially also to repay debt.
So is this the silver bullet then? Is this the thing we've been waiting for to finally draw a line under things?
I think you need to separate the silver bullet for developers when it comes to funding. Will we get more defaults? I think this lessens the likelihood of that, at least stabilizes things on the financial side, but you still have what I was talking about, the confidence side of things, and a downturn in the property market that's only accelerating. The latest data we had last week showed home prices actually fell in October, despite all the measures that we've seen this year, and they fell the most since February 2015. So there's still a downturn there, and if consumers and home buyers don't feel confident that this is going to stop, then you're unlikely to get them buying more. But I think this measure announced today, if it is confirmed, would be a step in the right direction for
Okay.
Sure.
Sophia, thank you very much. That is Bloomberg Sophia Orta y Costa. All right, joining us now to talk all things eco is Ludovic Chabran, Allianz chief economist. Ludo, another day, another move from China. Is this going to draw a line under the crisis, or is this just another act of desperation?
Hi, Danny. We believe that China has bottomed out in many ways. And so for me, this is the sign that they think that the cleansing of the real estate sector has actually happened. We saw a lot of credit going into, solar and manufacturing. So we thought, okay, maybe they really are okay with this credit crunch in the real estate, because that was a massive bubble that pricked, right? But now I think they're really trying to make sure the social consequences are under some form of control. They're trying to circumscribe whatever second round effect on liquidity this could have on the financing sector and so forth. So for me, it's actually a positive sign more than a sign of despair. But as you know, China is on this structural adjustment phase, and they really need to find sophisticated policy making to make sure they don't recreate a bubble, and they actually don't have this Japanification or this strong depression, financial depression coming from this real estate crisis, which is, it's going to take 10 years to absorb this this real estate crisis. So there's not out of the woods, but I think this move is a decision to make sure that they feel okay maybe with new credit coming in without having another wave of defaults.
Does that mean then, if this is sort of a slow-moving thing, to find that fine line between support and causing a bubble, that this is what it has to be, that the pace has to be this slow drip of measures?
It's very hard, because I think they're not sure that what is left is as secure as they would like to be. Think about what happened with the Lehman moment in the US, so I think the dripping of the measure, and we expect more on the fiscal side. We expect more also on the reserve requirement rates. I think they're going to cut for another 2 or 3 times. I think they're really trying to make sure that they don't completely kill the economy. I mean, that's really, they have to jugulate the second and third round ramification of a real estate crisis. But I think most of it is already there. So now it's a question of restarting on a good basis. The problem with this basis is that the Chinese consumer doesn't trust the policy making. The savings rate in China is equivalent to 56% of GDP. When you talk to the Chinese consumers, high net worth individuals, companies, they tell you, we don't know where to put the money yet, because we're not sure that we're done. And I think that's what China is trying to do now, is recreate trust, so that there is this investment function coming back, not only in real estate, but more generally that the savings of the people is going into something that crashed. I mean, the most Chinese lost the pension. That's what happened with this real estate crisis. So now they need to go back into having a form of secured investment into something. And so maybe this type of measures is helping, but I think they will need much more. They will need much more.
I mean, there's always just this massive contrast between the Chinese and European consumer for that part, which has this propensity to save, versus the American consumer. And Ludo, we can speak ill of them because they're not watching. They're all off for Thanksgiving. But you do see things like the New York Fed, for example, had this study, and they went around, they asked people, if you had to come up with $2,000 in the next 2 months, could you? And the lowest number of people said that they could since they started collecting the data in 2013. There do seem to be some pretty wide cracks in the consumer. When does it turn from a crack to something that does potentially lead the next downturn?
Well, I think that's the very open question. That's why you see the most dispersion in analysts, including, in the way they look into 2024. We've been calling it for quite some time. We thought the excess savings from COVID would actually completely melt under the sun by Q3. That's exactly what's happening. We see now the net financial positions of American households back to where they were in late 2007, so before crisis times. So I'm particularly worried about the suffocation of the American consumer for 2024. The indebtedness and the affordability of this debt is really a question. So I'm particularly worried. I think what is working in the right direction is the real wage effect. So you have high wage growth and you have less inflation. So that should be a positive effect on real disposable income of households. I think what is working on the favor of consumers is also the wealth effects that are not so bad. Negative wealth effects from the housing market correction are limited now. And on the other side, you see that the financial markets are doing a bit better than what they were doing with the high volatility on the bond market. So I think it could actually still be in soft landing territory. But I think the distribution of risk is to the downside. I'm a bit worried about the cost of living crisis staying on and morphing into this idea where you start to have a form of deconsumption from the American households, for sure.
But isn't there, again, I got to say, Ludo, what you're telling me, especially given that the COVID savings drying up or starting to dry up didn't seem to affect anything. I mean, who's to say if there was a downturn that you just wouldn't have Americans just spend their way through it?
Well, this is, the cost of, I guess the bank lending standards and the cost of financing is the ultimate, pull factor to not having Americans spending their way into the next crisis. But to be fair, when we look at, for me, 2024 in the US is going to be another 2016. Very polarized, very limbo type of year, where you're going to have this, US elections are coming up. And so this is going to be a wait and see mode, including for the consumers. So you're going to have flashing signs of, corrections and flashing signs that it's okay all through the years. In our forecast, for example, we have 2 or 3 consecutive quarters of zero growth in the US. Call it a recession or not, maybe we will call it a recession afterwards. But I'm quite confident that there is in a way a restriction that is in the making, also because people want to see what's going to happen on the tax issues.
Right.
So that's also why they're not going to get it through.
Ludo, stay with us. We have much more to discuss. That's Allianz's Ludovic Chabran. Now, ECB Vice President Luis de Guindos is warning investors against what he calls wishful thinking on the strength of the euro area economy. He spoke to Bloomberg's Alex Weber in Frankfurt yesterday.
This is one of the main risks because now the outlook that markets are taking with respect to the evolution of the economy. I would say that it's a little bit sanguine and so optimistic, and there is a little bit of wishful thinking, if you allow me to say. So if growth is below what we are expecting or what markets are expecting now, if you have any sort of let's say additional geopolitical risk. That's something that we have to take into consideration because so far even the situation, the conflict in the Middle East, the impact on markets has been quite subdued, has been quite limited. Well, that kind of situations when you have a very low risk premium for both corporate bonds and equities is something any sort of deviation with respect to this very benign scenario could give rise to problems and to surprises, negative surprises, and reactions in markets because prices are very high.
What about expectations for the first interest rate cut? Currently, investors expect such a move as soon as April. Is that too optimistic?
Well, I think that it's premature to talk about that. We have increased interest rates, 10 times, as you have said before. We have kept, rates on hold. We will continue with this continuation of our investment of APP portfolio. Let's see what happens with PEP, as I said before. And, and I think that, we are going to be data dependent. We will see how, the different, the inflation evolves over time. We believe that the disinflation process will continue over the next 2 years, even though, because of base effects, you can have some upticks of inflation over the next months in the short term. But in the medium term, we expect that at the present level of interest rates, our monetary policy will give rise to, an important reduction in inflation, and that eventually inflation will converge to our objective of 2%.
ECB Vice President Luis de Guindos. Now coming up, a surprise victory. A far-right lawmaker wins the Dutch elections. We'll have the details for you next. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
You're watching Bloomberg Markets on this Thanksgiving Day holiday. I'm Danny Berger in London. Now, a recession in the euro area is perhaps looking more likely. Economic downturn is persisting in the final quarter of the year. The latest PMI data came in showing just that. Joining us now to discuss is Bloomberg Economics Chief European Economist Jamie Rush. Jamie, how bad was the data, especially given sort of a gloomier outlook even de Guindos was talking about of not being too wishful in your thinking?
Well, I think it comes down to what sort of recession we're talking about, right? So if we're talking about a recession where GDP growth is a little bit negative for a couple of quarters, I don't really regard that as a serious problem. It's not going to put a huge dent in the labour market. It's not going to change the outlook radically. I think what we're looking for is the possibility that output starts to suddenly sour. And because that's the risk. We've had 450 basis points of rate hikes. Our economic models tell us this should be leading to a recession, really. It hasn't happened yet, so we're on the lookout for signals that could be coming. When we look at the data today, that's not really what we see. What we actually see is a stabilizing outlook. So, yes, weak, yes, bumping along the bottom, but not really something that's that troubling.
Is a stable outlook then consistent with market pricing of cuts starting in June for the ECB?
I think it probably is, actually. I mean, if you look at what generally people in the markets are forecasting, economists are forecasting, it is a little bit more of the same, and then things getting a little bit gently better in the kind of middle of next year. And so if we stick with that outlook and we believe that inflation is going to fall away as we're expecting, then yeah, okay, cuts are reasonable in June. If we see evidence that the pace of deceleration is gathering some momentum, then I think then we could start to see that pricing move a bit closer.
That makes sense. Jamie, thank you very much. That is Bloomberg Economics' Jamie Rush. Elsewhere in Europe, far-right politician Geert Wilders has come first in the Dutch elections. It's a shock result that's been resounding across Europe. The Freedom Party leader will now have to forge alliances in order to lead the country. Joining us for more on this is Bloomberg's April Roach. April, how surprising was this?
Hi, yes. So, yeah, as you said, Geert Wilders' far-right populist party is a surprise winner of the Dutch elections. And to a certain extent, this was, to be expected. He had been rising in the polls due to a late surge in the final days of the campaign. However, I don't think people expected him to win by such a wide margin. His party is set to gain 37 seats, more than doubling its representation from what it previously had in the government, whereas in second place, we see the Green Left alliance led by Frans Timmermans with just 25 seats. And in third place, the current ruling party, Mark Rutte's former party, they're just in with 24 seats.
What will the path now look like for Wilders to become the new PM and form a government?
Yeah, so the Netherlands is a coalition country, and even though Wilders' party is set to be the biggest, it has about just 25% of the vote. So in order for Geert Wilders to be Prime Minister, he'll have to form agreements with some of the rival parties in order to be able to form a government. And those coalition discussions could take weeks, could even take months. So it could be quite a while before we know who will become the Prime Minister of the country. And we can note that just once in recent Dutch history has the biggest party not become the Prime Minister of the country.
Okay, April, thank you very much. That is Bloomberg's April Roach. Still with us is Ludovic Chabran, the Allianz chief economist. Ludo, I mean, you've pointed this out in your most recent note. It's a Dutch economy that's recording quarterly contractions. We now have this move very right in the Dutch government. The market seems nonplussed. Maybe that's because it's lighter trading. But at what point should we care? Should market participants care about a move further right in European governments?
You know, you win one, you lose one, right? Poland, Spain were good examples of the forces of progress winning to a certain extent, and now we have the forces of darkness. I'm a bit worried because I think it is really the epitome of the cost of living crisis. When you know the state of the housing market in the Netherlands, you can understand why people could get very frustrated and vote extreme. I think the European elections are going to be a massive playground for anti-European parties. I'm a bit worried about the European elections having or resulting into the largest proportion of anti-European people at the parliament, and thus blocking some substantial, safeguarding policies and the type of stuff that Europe needs to move forward to make sure that they are fit for the era of industrial policy and fighting climate change and so forth. So I think the Dutch election is a bit of leading indicators of what expects us in May. Yeah.
I mean, and it's not even just Europe, Ludo. It's half the world's population is going to have an election next year. Do you think it's even foreshadowing that to a larger scale of the way the world is moving with this discontent over cost of living crises?
Yeah, the 2024 is, it's half of the world going to the polls. And, of course, the American elections will be watched like, would be under a lot of scrutiny. The European election also, Taiwan, Indonesia, Russia, India. Yes, there is definitely an election wave that is happening after an unprecedented cost of living crisis. And so, of course, there's going to be sanctioning of the leaders that were in power back then, much more than the wave of election we got just after COVID, which was confirming the idea that people that had managed the COVID crisis would stay in power. So that shows the centerness of economic policy wrongdoing and the fact that people, by deciding during COVID to avoid bankruptcies and recession and inflation, created a lot more debt, a lot more inflation, and now they're being sanctioned for that. And I think that's indeed a major effect, as we need a lot more collaboration and coalition of the willing for any of the big challenges that are thrown at us, including open conflicts and climate change and so forth. So yes, it's a massive pivot here, I think, 24, because of the political economy of inflation. Yeah.
Ludo, I got to apologize to you because before we went to the commercial break, we played tape of Louis de Guindos and made you sit silently by while he spoke. And I know you probably got some thoughts. He talked about there's a little bit of wishful thinking on part of the European economy. What do you take from what we heard from de Guindos?
I don't know. I want to be nice, but I think the central bankers should stick to what they should know. They shouldn't be ringing alarm bells about Europe. I think we have enough of those. They should take their part, because the second part of the interview is how data dependent they are. Well, if you're data dependent, maybe you should pivot at one point because you should avoid the recession. That's part of your job also. So I was a bit aggravated. You saw that, right? I didn't think his. This all let's raise the alarm bell everywhere. We know already the situation. Yeah. And now the question is, how do you manage a soft landing in Europe? And every policymaker should have hands on deck. That should be what they should be doing right now, because corporates are doing the hard way. They're doing the hard work to make sure that they stay afloat. You saw the PMIs. There is still, this possibility to avoid something a lot more negative, I would say, on the contraction in Europe, which is already happening in Poland and Germany as we speak.
Can I just say, Ludo, I mean, that was an incredibly nice critique. You critiqued him, but it was still nice. Everyone's still going to think you're a nice guy. Don't worry about it. Look, before we let you go, I want to talk about your new research note that you flagged to me. I'm just going to say the title and leave the rest to you, because this is so excellent. Gravy for corporates, leftovers for consumers. It's making me hungry, but what do you mean by that?
We in Europe want to be part of the big Thanksgiving celebration. So with my team, we thought, okay, let's look at the food sector, because a lot of people are concerned about the food sector. And we looked at turkey prices, and turkey is really interesting. Prices for consumers went up, prices for producers went down. Why? Labor shortages. And when you look at the food industry, you see this cognitive dissonance everywhere. People are down trading because food costs are so high. And then we see margin in the food sectors that looks like there are a lot of profiteering. like food packaging sector. Margins are going from 12% to 15%. So that's a big, profitability gain for some of these sectors when people are really consuming less. In the US, over the past 12 months, food consumption in volume terms went down 1.3%. So we just wanted to be a bit provocative with this idea that the food sector is going to be, and you see the political ramification of this, the situation on the normalization of the food sector is going to be massive to subjugate the cost of living crisis on the most vulnerable among us. Yeah.
Luda, that is so fascinating, and let me tell you, this is why you have American friends like me. Next time, come to London. I'll host you. I'll get you into the American Thanksgiving joy. Ludo, thank you so much for joining.
Thank you.
Allianz's Ludovic Sivan. All right, coming up, we're going to be speaking with Colin Graham, head of multi-asset strategies at Robeco. First, a quick check on your FX markets. As we go to the break, euro is stronger today, maybe despite some of that gloom from De Guindos. Stronger PMIs coming out of Germany and the UK. Surprise hold from Riksbank. Weakness in the krona, waffling back and forth, just slightly stronger versus the dollar. A strong Aussie after RBA comments and support from China.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Welcome back to Bloomberg Markets. I'm Danny Berger in London. U.S. markets are closed for the Thanksgiving Day holiday. Even so, we do have a Treasury trade in the futures session. It has been looking slightly weaker after yesterday's weakness off the back of a UMich reading and a jobless claim data that did seem to sort of amp up some of those hawkish bets, maybe slightly undoing the cuts that have been priced in and the rally in this bond market. Meanwhile, euro and sterling strengthened off the back of stronger PMI data. We're just speaking with Ludovic Chabron, who was rather gloomy on Europe and the UK, but perhaps not as gloomy as Louis de Guindos. Meanwhile, Brent crude, that declines for a second day, down more than 1% off the back of a delayed OPEC Plus meeting. But I would just say, keep in mind with all of these, it's the Thanksgiving Day holiday. Not only is the U.S. closed, but Japan is also closed. So volumes across the board are going to be a bit more weak and maybe more volatile. Now, of course, as soon as I say that, I'm going to show you what U.S. futures are doing. So, I don't know, grain of salt with all of this. S&P 500 futures, they are flat. We've had this huge move on the month. You've also had this huge move from retail investors. J.P. Morgan points out that they had their biggest weekly inflow into U.S. stocks since April of 2022. European equities fight back to gains, while MSCI Asia Pacific, without Japan, because of course it's also closed for a Labor Thanksgiving Day holiday, moves higher, led by property stocks, which at one point were up 9% with more measures coming through China. So it's been a big move over the past month. We're now back flat for treasuries on the year in terms of their performance. And we also have S&P 500 that's up 8.6% for November. So what do you make of this move? Colin Graham of Robico writes that we think recent equity and yield moves are more about positioning squaring rather than a new outlook. Immaculate disinflation is market consensus, and we expect higher yields in equities to go nowhere from this knee-jerk reaction. Well, Colin joins us now, who is the head of multi-asset strategies at Robico. Colin, how do you invest in a no-go-where market? What do you do now after these moves?
Well, I think you still look for those opportunities in the world. I think you can see that. You can look through various lenses in terms of the valuations, in terms of the macro, and in terms of the sort of technicals. And I think the recent moves have been really driven by the technicals. If you look at the macro, and we've heard some of your other commentators talk about the downbeat European outlook, but this is one area where you could actually see positive surprises because everybody is so downbeat about Eurozone. And also valuations are cheaper in the Eurozone. So from that perspective, you can think of the bonds and the equities within Europe as being reasonable value, and then you have to figure out what's going to happen over the next 3 to 6 months to change the market consensus on that outlook.
At least for the end of the year, I mean, there's no really huge catalyst, but I got to wonder, Colin, when it comes to European bonds for next year, we were speaking with Laura Cooper of BlackRock earlier, and part of the reason she said she liked them was that there was a higher likelihood you get ECB cuts before the Fed, that accommodation comes in sooner. Would you agree with that view?
As a team, we were talking on the desk about that yesterday, and we don't think that is the case. We think the ECB will always follow the Fed. I think it will take something catastrophic or indeed something out of the ordinary that we can't predict in order for the ECB to go first. And you don't have to just think about that. We're talking also about China connection here. And if China starts to get the property concerns under control and becomes more investable from a sort of a return perspective, then you'll start to see actually Europe should start to pick up due to the connections in the economy with China. So China's been in the doldrums, and that's one of the reasons that Europe has been sort of lagging behind the US. You also look at the energy complex as well, and with the OPEC Plus meeting being delayed and further cuts, obviously, discussion has been pushed out. That could also lead to an uplift for Europe as energy prices come down.
What about in the U.S.? Because you've closed your underweight in global equities. Now you've started to buy back hedges on U.S. large cap stocks. What's brightened your outlook?
I think it was just the extreme pessimism here. We still think that Goldilocks is not the right outcome for next year. We think there's going to be surprises on inflation. We think that rates are going to have to be higher for longer. So we're still cautious, but we just realized that actually, you can still make returns being cautious on equities. and therefore closing up that underweight in an environment where you can see the markets where all the catalysts for a short-term bounce were in place, then that seemed like the sensible thing to do in order to protect our clients' performance.
Okay, so if we are going to be higher for longer, do you want to push back against what the American bond market has done over the past month to price in 100 basis points of cuts by the end of 2024?
Totally. We're actually short duration in our portfolios at the moment, and looking to go use the Japanese duration and the US duration to go shorter. I think one thing we have done is our target prices for US 10-year treasuries have come down. So we're looking more at 4.5 to 4.75 for the US 10-year as being an area where we would actually be thinking more long duration. So we have some space to play here. And we think if Treasury yields fall further into the year end, then that would be an opportunity to actually sell those. Because again, you've got to look at where short-term rates are and where cash rates are, and those are become more attractive as long-term yields fall.
And then while we're talking about bond markets of the world, we might as well do the UK too. I know you've removed your long UK gilt position. If you look at the PMIs today, Colin, where they come in stronger than expected, and you have S&P, for example, in this report talking about strong wage inflation, the need to pass on higher fuel costs to consumers, and that's what pushed up average prices in November. Does something like that make you maybe rethink where this gilt market is going? Is that why you say, okay, perhaps now is not the time to be long gilts?
I think so. I think the reason we went long gilts was the yields were tracking all the other economies and all the other gilt markets, and it was all been driven by the US. But the UK was in such a different place from an economic perspective and policy perspective that it didn't make sense for UK gilt yields to track US gilt yields because the economy was very much different, and a different stage. So we are seeing more balanced. We saw the budget yesterday, so we still haven't digested everything that means for the short term or indeed the long term. But again, we'll come back to this and reassess it once we get this new information and we understand what's going on.
Okay. Colin, thank you very much for joining us this morning. That's Robeco's Colin Graham. Now, Israeli officials are signaling that a release of hostages from Gaza and a pause in fighting would be delayed. That's as negotiations with Hamas continued. The 4-day pause in fighting and release of hostages had been slated to start today, but Israel now says that won't happen before Friday. Bloomberg's Honor Ant joins us now from Istanbul. Honor, why has the truce been delayed?
As you said, the deal for truce and release of hostages has been delayed by at least a day, based on what Israelis have said so far today, and just that highlights how fragile and dynamic these talks for the deal are. There are two sides to the party which are locked in a bitter battle, and obviously they're not talking to each other. So it's up to the mediators, led by Qatar and to a lesser extent the U.S. and Egypt as well, to basically circumvent the major distrust that there exists between the two parties. So they're doing everything they can to make sure that this deal comes into fruition, but it looks like it's been delayed by at least a day, and we know that the mediators and both sides are trying to secure the release of hostages held by Hamas in exchange for a release of about 150 Palestinians currently held in prisons in Israel.
Well, if you look at some of the messaging coming out of Iran, for example, Honor, you had the Iranian foreign minister on Telegraph issuing a statement to the Hezbollah leader saying that the truce deal between Israel and Hamas is the result of the resistance and a steadfastness of the Palestinian nation. There is this persistent fear of escalation, of even more involvement than we've seen so far from the borders of Lebanon, from Hezbollah. In terms of that fear, where do we stand? Has it grown? Has it ebbed?
It is very important where Iran stands and what kind of messages it sends. As you said earlier today, there was somewhat a cryptic message out of the Iranian foreign minister who is traveling to the region today. But yeah, elsewhere in Israel today, when you look at the north, there have been about 50 launches of Katyusha rockets by Hezbollah, which is a militant group backed by Iran and currently located and based in Lebanon. Those rocket launches came after what Hezbollah said was an attack by Israelis at a post inside Lebanon where 5 members of the militant group were killed, including a person who was believed to be the son of Hezbollah's own bloc in the Lebanese parliament. So very important target, obviously, and that seems to have sort of triggered a very strong retaliation or response by Hezbollah. But also elsewhere in the region, we have seen some signs of a possible escalation, including launches of drones by, again, Iran-backed rebels in Yemen, the Houthis. Those drones were intercepted by a U.S. Navy destroyer that was in the Red Sea on a patrol. But obviously that incident itself shows the risk of outside threats to this pause in fighting that would materialize if the deal goes through.
Okay, Onur, thanks for joining us with the latest on that. That's Onur Ant in Istanbul. Now let's pivot now to oil, because the decision by OPEC Plus to delay its upcoming meeting by a week is dragging oil markets lower for a second day. It's cooled speculation of further production cuts by the group. Joining me now is Bloomberg's Will Kennedy. Will, is that a fair takeaway? Do we look at a delay and say, okay, perhaps less supply cuts are coming?
I think it's too early to say that. I think what we can say is that it proved hard for OPEC to reach a deal in time for the meeting this weekend, and it became clear this week that that wasn't going to be possible and that they had to delay a while, which suggests that not everything is well within the group. What exactly the problem is, we have no public statement from OPEC or any of the ministers, but we understand that some of the African members of OPEC, Nigeria and Angola, for example, are unhappy with the terms of a deal that actually was negotiated earlier in the year, that they would have their quota reviewed by independent analysts, and the outcome of that review, we understand, is back, and they don't like it, and that's caused disagreement within OPEC. That's in a broader context, I think, of a difficult meeting for OPEC, where the outlook remains uncertain for next year, and that they may feel that bigger cuts are required and how those cuts should be shared.
If there is this discord among members and coming from the African members, does that at all put into threat that Saudi is less willing to kind of be that swing producer, that perhaps they don't want to take on this role if there can't be a wider agreement in their disputes between members?
I think that's a reasonable supposition. Clearly, going into this meeting, Saudi Arabia was doing a lot of the work. Its production is down at 9 million barrels a day, quite low by historical standards. It had topped up the agreement to cut production made earlier this year with a voluntary 1 million barrel a day cut on its own, and the expectation was that it would extend that into next year. It may well be that Saudi Arabia feels that if there's more work to be done here, if production cuts need to be steeper, they need to be shared more broadly throughout the alliance. We don't know the details of that conversation, but that may be at the heart of the problem here, and as you say, a more, in Saudi eyes, equitable sharing of the burden.
How high then is the bar to have a meeting where they're able to push up prices, that's able to have a positive price reaction? Is that bar just much higher now?
It's difficult to say. I think one thing I would say about the price action is actually perhaps the sell-off hasn't been as dramatic as it might have been. We live in a time where very volatile one-day moves in oil are quite common.
Yeah.
You know, we're here a lot talking about 3, 4, 5% swings. We had a big sell-off yesterday, but at the end of the day, we've had this surprising delay to the meeting, all this concern, and we're still holding above $80 a barrel. Oh. It might suggest that the foundations of the market aren't quite as bleak as people think.
It's a good point.
But we will not know until we get a result of the meeting.
Yeah, even the bond market swings more at this point than what we're seeing from oil today. Will, thank you very much for joining us, Will Kennedy. Now, coming up, we're going to bring you our interview with the JCPenney CEO, Mark Rosen, next. You're getting your Christmas shopping in. This is Bloomberg.
So the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to Bloomberg Markets. I'm Danny Berger in London. Your U.S. markets are closed for the Thanksgiving Day holiday. And this is typically one of the busiest holiday seasons for spending. Perhaps you're gearing up to take on some Black Friday shopping. But even as inflation takes its toll on the consumer, the CEO of JCPenney, Mark Rosen, says that they still expect holiday spending to be similar to previous years. He spoke to Bloomberg TV. Take a listen.
What we're seeing is half of consumers are actually saying they are going to spend more this year. I think what you are going to see is that consumers are much more focused on value than they've ever been before, and we're seeing that in shopping behavior this year.
We've had some earnings reports from folks like Burlington and TJX, which seem to show that trend certainly in place. A lot of folks trading down, and it's not just low-income consumers. You even have higher-income consumers also trading down as well. And I'm wondering whether you've actually seen that in your stores as well.
Yeah, so I think if we step back for a minute and just talk about our consumer. The consumer in our store is, we say our customers America's diverse working families. It's a $75,000 median household income. So if you think of our customer, it's the teachers who are teaching our children, it's the medical workers who are taking care of us and our families. And for that consumer, inflation has definitely been a challenge. And so what we're seeing is the consumer is looking more for value. The consumer is more focused on price. We're seeing more responsiveness to when we're offering promotions and things like that. And, we've been really successful by doing what we're saying we're doing, which is taking inflation out of the holiday for our customers. We've gone back and taken hundreds of items that we had last year, and we're offering the same price as last year or lower. And we have thousands of gift items that are under $15 for our customer.
I'm curious as to how you're pricing this. When you say at those low prices, are those basically, I guess, the full retail price, if you will, meaning that low price, or is that the price you get to after taking into account a discount or coupon?
So I'm talking about the Black Friday price, okay. And so our Black Friday prices are the lowest prices that we offer.
How are you going to get people, I guess, to buy? Is this about getting them physically into your store locations, or is this going to be much more of an online e-commerce strategy?
I think it's going to be a bit of both, and we've seen success across both online and in store. We launched our Black Friday early. We launched November 3rd through 5th, and we saw great success. We saw a big increase in our store traffic, and we also saw really strong buying online. If you think about the event that we're going into, tomorrow, Thanksgiving Day, will be an online day. And Friday, Black Friday morning, is going to be an in-store day. And to really encourage that in-store experience on Black Friday morning, we're going to have events going throughout the day. So we have events starting at 5 a.m., again at 9 a.m., 1 p.m., and 5 p.m. And just to give you a couple examples of what we're going to be doing, some customers will actually get $500 off a $500 purchase. In other words, we'll pay for their entire purchase. And that will be by a snap pack that they receive when they come into our store that will have coupons in it. And at 1 o'clock, we're going to be giving away diamonds. There's a diamond pendant necklace in each one of our stores and 30,000 diamonds spread across our stores. So that's going to keep the excitement going in store throughout the day.
Who doesn't love some free diamonds? That was the CEO of JCPenney, Mark Rosen. Maybe that's why the price of diamonds is crashing. All right, tomorrow, on Black Friday, Bloomberg's Caroline Hyde is going to be speaking to the CEO of Macy's. That's Jeffrey Gannett at 7 a.m. Eastern. So she'll get a read on just how much that Black Friday spend is going to shape up to be. And while Thanksgiving spending might be in line in previous years when it comes to clothes, it does appear that the Hollywood box office is feeling the pinch. This is usually one of the most lucrative periods for the film industry. You get the family together, you go see a film around Christmas, after Thanksgiving. But Disney's newest animated film, Wish, is confronting a shrinking Thanksgiving box office. Bloomberg's Alex Webb joins us more for now. I mean, Alex, I have to be honest, I don't really go see animated films in the cinema, but I love an animated film. I mean, why are people going out to see this? Why is there disappointment?
I mean, there are a number of different things. Animated films, obviously, on the whole, not exclusively, but targeted towards kids. You know, taking the family out is expensive. We're in a bit of a cost of living crisis in large parts of the world. If you want to spend conservatively $50, $60 to take, a family with 2 kids out to the cinema, it's clearly not an insubstantial amount of money. You have a number of other factors playing into this. Firstly, the film has not had good reviews. It doesn't appear to be very good. Secondly, you have got you're coming off the back of an actors' strike where it meant they weren't able to go and promote it in the run-up. Usually you'd have the full Disney promotion machine cranking up in anticipation of this film. And thirdly, you've been teaching your audience to watch this stuff on streaming. That's what's been the case for much of the past 2-3 years, that they've been putting all the stuff on streaming either first or within a few weeks of putting it in the cinema. So now people know, well, why should I bother spending perhaps it's $50-$60 to go to the cinema when I can watch it at home in 2 or 3 weeks? And you put all those things together and it starts to get a little bit unhappy for Disney's taking on that.
But if you've taught consumers that they can just wait and watch a film, which is, honestly, I've learned that to the point where even if I know it's not going to be on streaming, in my head I'm like, at some point, surely this is going to go on the streaming network, so I'm not going to go see it. How do they dig themselves out of a hole like that?
Well, that's why you start putting less on streaming and less exclusively on streaming than you did before, and that is something that Disney is doing. What we've seen, a huge pivot at Disney twice in the space of 3 or 4 years, where they moved away from issuing growing dividends towards trying to be a growth stock. Now we're seeing a pivot back towards the dividend. The growth stock was really about investing billions of dollars in content for Disney Plus and trying to chase a valuation that was similar to that of Netflix. It did succeed. Until then, interest rates went up and people weren't sitting at home as much as they were during the pandemic. So you're seeing a pivot back to the previous model. That also means bigger windows, perhaps, between release in the cinema and release on, your streaming platforms. But that's still very early days. Maybe it'll take a little bit of time for that to start coming back into the popular consciousness.
The other interesting dynamic of this is that Hollywood just isn't making sort of mid-budget offerings for the holiday season. We're talking about 2018, where they released during this period Ralph Breaks the Internet, Creed 2, Fantastic Beasts, The Grinch. I haven't seen any of those movies, I'm going to be honest. But why is there this slow? Does this have to do with the actors' strike or the writers' strike that there's not enough offering? I mean, did they just get the holiday slating wrong?
Yeah, I mean, look, it wouldn't have an effect on this Thanksgiving, the strikes. It might have an effect on next Thanksgiving, potentially. The promotional element, of course, is part of it. The mid-market stuff, the mid-range stuff, the sort of 20 to 40, maybe 50 million budget, those are the ones that tend to go straight to the streaming platforms. They don't get the cinematic release. The assumption is you've got to have the big budget spend. To go with that big budget spend, you need a big budget marketing spend. Often, if you're spending $150 million on a film, you're spending another $150 million globally to promote it. And it's, big chunk of change. The thing is, though, those films haven't been made for quite a while, at least not for cinemas. You were talking going back decades now. I think it was 1987 is the one that our colleague Tom Buckley writes about in his story. That's when 3 Men and a Baby came out. Those films, hard to get across the line. You do see some of them starting to creep back in, and a few little hits. A24, for example, the independent studio, has really carved a niche in doing these things quite effectively. But on the whole, those are the films going direct to streaming.
All right, so I take it you're not going to go see Wish in the cinemas, Alex?
I'll wait for it to come on streaming.
Disney, just Bob Iger, hold your ears. Don't listen to Alex Webb. Alex, thank you very much. We, of course, love to listen to. All right, now let's get to some of the other top stories that are trending on the terminal this morning. Warren Buffett says his will is going to be simple, and the donation of his fortune to philanthropic causes will be public. The 93-year-old says he still feels good. He's worth $121 billion, according to the Bloomberg Billionaires Index, and he donated more than $868 million to 4 foundations. The governor of New York says there is no sign of terrorism so far in the vehicle explosion that killed 2 people at the Rainbow Bridge. It's a busy crossing between the U.S. and Canada. Kathy Hochul says that a suspect with ties to Western New York has been identified, and the investigation will determine if it was intentional or accidental. Now, Novo Nordisk is to invest $2.3 billion to expand production in France, creating at least 500 jobs. The Ozempic and Wegovy drug manufacturer has been facing supply bottlenecks, mainly due to high demand for its weight loss medicines. UBS CEO Sergio Ormati is calling for stronger regulatory measures for Swiss banks to avoid issues like those that led to the collapse of Credit Suisse. He says, quote, it should be easier for the bank or the regulator to go after people who demonstrated great negligence in their duties, adding that accountability needs to be strengthened. Well, as we head to the end of the hour, let's look at this more quiet trading for the day. It is all about a weak dollar as it has been. Is the pivot finally in? You're looking at a stronger euro and a stronger sterling versus the dollar. Data coming in from PMIs above expectations. Meanwhile, the OPEC Plus meeting is delayed. Now, coming up the next hour, we're also going to hear from Berenberg's chief economist. But hopefully you can get out there and enjoy some turkey on this Thanksgiving.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
We've been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
He's
story.
there, the kind of upside.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Welcome to a special edition of Bloomberg Markets. I'm Kriti Gupta. The U.S. markets are closed for Thanksgiving, but don't worry, we are here with you today. Happy Thanksgiving, by the way, to everyone across the pond. Let's take a quick look at how things are looking out in Europe right now, because, of course, we know there is quite a bit of low volume when you look at trading. S&P futures doing virtually nothing, 45.69 on those contracts. But if you look at those 10-year bond futures, starting to see a little bit of a bid. But remember, the Treasury market is closed, so whatever you see in today's session is only going to show up in tomorrow's, again, very, very thin volume trade. But as those contracts come full down in those futures contracts, I might add, it is going to be weighing on the dollar. Bloomberg Dollar Index weaker by about 0.2%. Brent crude off the back of that still in line with perhaps some of the very light risk sentiment, down 0.8%. We're going to be diving in the next 2 hours of what is going on in the oil markets, given, of course, OPEC has now delayed that decision. Brent crude trading at about an 81 handle. Right here in Europe, though, a little bit of a different story. And let me walk you through that story as well, because like I said, we are seeing some dollar weakness, and that is really fueling the currency trade right here in Europe. Euro dollar 109, the cable rate at about 125. But even when you look at the actual stock market as well, stocks Europe virtually unchanged thanks to that low volume trade in the United States and around the world. FTSE 100 actively lower, down 0.2%, underperforming. But again, no major moves in either direction. Did I say it was Thanksgiving? This would explain everything. In the meantime, whereas we aren't getting a ton of action in the markets, we're getting plenty of action in the world of geopolitics, specifically in Europe. I want to come to our top story here. Far-right lawmaker Geert Wilders' Freedom Party has now claimed 37 seats in the Dutch elections, a shock result that will resound across Europe. For more details, let's bring in Bloomberg's April Roach. She is joining us from Amsterdam this morning. April, walk us through the story here when it comes to this really surprise turnaround. A month ago, 6 weeks ago, somebody else was in the lead. How did we get here?
Yes, that's right. So Geert Wilders' far-right populist party is set to become the biggest in the Netherlands, with quite a surprise victory in the Dutch elections last night. And there was a late surge in the final days of the campaign that saw Wilders rise to the top of the polls. And his party is anti-Muslim and has some tough policies on cracking down on immigration. He's also spoken out against sending so much aid to Ukraine. And now his party is set to gain 37 seats, more than doubling its previous representation in the government. Whereas you see in second place, the Left Alliance, led by Frans Timmermans, is there just with 25 seats. And the current ruling party, which is Mark Rutte's former party, has just 24 seats. And I think, as I said, we did see him rise in the polls leading up in those final days, but I don't think that people expected such a wide margin win for this party.
It comes amid a larger backdrop of the Netherlands, kind of known as being this very liberal country in broader Europe, to really starting to lean towards closing their borders, leaning on the fact that they're dealing with budget concerns the way that I would argue every other country, not only in Europe and around the world, is. Can you tie in the broader economics here? Why this push now?
That's right. I mean, immigration was one of the big topics in the lead up to these elections. There's also a housing crisis going on at the moment, which is also ends up getting tied in with immigration. And so with these issues, you can see that Dutch people were really looking for a change in leadership. And that has really swayed the voters to this party. So those themes have had a really big impact here. And it was also the issue of immigration, which saw Mark Rutte collapse the government earlier this summer. So those were the key themes that sort of have brought us to this moment.
I mean, it's a really interesting dynamic because, again, we've seen not only the immigration conversation, we've seen flights cut from the UK to the Netherlands as well. We've seen foreign tax incentives cut as well. April, in terms of this change in leadership that you were just talking about, Mark Rutte also in line, potentially, or at least in the running, I should say, for being the helm over at NATO. What happens next in Amsterdam coming into the next year or so when it comes to Dutch politics?
Yes, I mean, so the Netherlands is a coalition country. So in terms of, who will be the next prime minister, it could take us quite a while before we find out. Even though Geert Wilders' party is set to become the biggest, he still needs to make agreements with some of the rival parties in order to be able to form a government. And those talks can take a really long time. It could be weeks or it could be months before we find out who the next prime minister is. I mean, it's interesting to note that just once in recent Dutch history has the biggest party not to become the prime minister, and it is the biggest party that will take the lead in those discussions. So it could be a while before we really get a clear picture of what will happen next.
It's certainly something we're watching very, very closely. I know the markets certainly are, not to mention the lead it perhaps set for broader Europe. Bloomberg's April Roach joining us from Amsterdam. We thank you so much for that crucial insight. I want to continue the conversation on, again, that far-right lawmaker, Geert Wilders, winning the Dutch elections in a really surprising turnaround. We're joined now by Sandra Philippin, chief economist over at ABN AMRO. Sandra, a pleasure to have you on the program this morning. Walk us through your initial reaction of those election results.
Yeah, it was quite a surprise to start with. And so what's going to happen now as a first step is that, indeed, as April said, it remains to be seen whether and how fast a new coalition will form. What we have seen in the last week is that in the election campaigning period, a number of parties from the right to the far right have basically put out restrictions to working together with the PVV. Of Geert Wilders, but now actually since the moment of winning the campaign by the PVV, you basically saw already a different tone in the other parties, and it looks like they are more willing to get into a coalition with the PVV, and that would mean that we would really get a coalition ranging from right to far right, and we've been looking at what that might mean for policies going forward.
Well, it feels like from a fiscal perspective, I should say, specifically for the Netherlands, there was a really interesting market call that Natixis had actually made in the last 48 hours or so, basically saying that Dutch debt actually looks significantly better because in the kind of constraints of some of this immigration policy and new structural thinking that they have, they're also going to be talking about pulling back on some of their fiscal spending, and that might actually be a positive when it comes to just how much they issue in the bond market. Sandra, let's talk a little bit about the Dutch budget here. What's the read-through?
Yeah, well, we actually think it will go the other way. So the four key areas where, basically, if you look at the election programs that the PVV, but also the VVD, NSC, sorry for all the Dutch jargon here, but and the farmers movement, BBB. So if you look at the programs, and that's a very hard juggle because, for example, the PVV has only a one-pager for a program, and no budgetary consequences are calculated. So that's a hard guess. But if you kind of try to make sense of what's in there, then you see four key areas that might be shifting. So the one is on social spending. So just to give a concrete example, the personal contributions to healthcare are in those programs likely severely going down to even be zero. And that is a big budgetary consequence of around 6 billion euros for healthcare. Now, there's also a lot about minimum wage because, this is the far right, but on social policies, they're actually far left. So what you see here is that minimum wage and connected to that elderly care and also social wealth spending might go significantly up. Then there are these, indeed, on climate policies, there is a potential pedaling back of policies. But whether that turns out to be good or bad for the deficit really depends on what those policies forward were going to mean for the budget. So, for example, if you think about a carbon tax, that's an upside for the budget, while if you think about the subsidy, that's a downer for the budget. Now, the Dutch government has actually been rather neutral on budget spending on climate. So it's mostly a combination of pricing, subsidies, and regulations. And it's not clearly that kind of pedaling back on that is going to be an upside to the budget. So we actually think that the policy areas I mentioned, but also the policy reforms, so on the pensions. So we have just had a huge pension reform in May in the Netherlands. The question is, and if you look at the parties of the programs of, for example, the Farmers' Party, they are actually vocal about moving back to a defined benefit system instead of a defined contribution. So, and that could have also severe budgetary consequences. It's very uncertain where this exactly is going to go, so you can't really put a number on it yet. But I think this is something to watch carefully. And so all in all, we think that if you look at it from the budget deficit side, it's more likely that the budget deficit will be higher than lower in this coalition.
Another thing that we're watching very, very closely, to your point, in addition to the budget, is going to be the labor conversation as well. Sandra, if I can just bring you some breaking headlines from ASML. Of course, the world's major chip equipment maker, headquartered in Amsterdam, making about 15% of the stock market. Those headlines basically saying that they're calling on the Dutch government to take measures to boost the Dutch talent pool. The ASML is also saying that the restrictions on knowledge workers are, quote, undesirable. And lastly, the expat tax cut change and buyback tax may have a serious impact, basically in terms of attracting the knowledge pool that they need in terms of building out their business and their global demand. The immigration policy and the budget concerns that we've both just discussed are actually working against them. Sandra, your initial take on the read-through into the corporate side?
Yeah, that's another really worrying feature. I mean, the general tendency that we're seeing from the party's programs that have been big in the election, except the Labour Party, Green Left, of course, is that it is a tendency to turn inward. So that means in all kind of hard to quantify, in the short run, hard to quantify elements, such as indeed expats are disincentivized to be in the Netherlands. Students are in their colleges, they're to be taught in Dutch instead of English. This will have consequences for teachers in academia because a lot of academicians in the Netherlands do not speak Dutch. And so if they are not able to teach, then the question is, will the Dutch-speaking academicians take all the teaching burden, or will something start shifting there? And then you're really talking about slowly eroding your knowledge economy by looking inward and putting the world outside, and which is a remarkable phenomenon for the Netherlands, which basically has built all of its wealth on its international openness. So it's a very worrying feature.
And Sandra, we have about a minute left in this conversation, but then talk us through how much pressure that then puts on the inflationary pressures that already exist. If you were then limiting the talent pool even further, doesn't that just create more worries on the inflationary front, both from a wage perspective, but also in terms of supply chain issues that you would then see going into the Netherlands?
Well, what this exactly is going to mean for example, inflation, that's really too early to call now because we don't even know what policies concretely are going to look like. But one thing that I think is relevant here is that if you look at climate policy, so what's going to happen if we're going to pedal back on our climate policies? We will still have our legislated commitments, right? And so we will still be within the Eurozone, and we will still be facing the Green Deal. So what you will get is a divergence between execution of activities in the Netherlands on climate and basically legislations that we have committed ourselves to. And that divergence might, in the very short run, seem kind of rather less costly. In the medium to long run, you will see that this divergence might lead to lawsuits, and these litigation cases might lead to more disruptive scenarios for the transition in the Netherlands, and that's inflationary.
Yeah, certainly a scary concept for those who are trying to push down those inflationary pressures. Sandra Philippin of ABN AMRO, we thank you so much for breaking down not just the election results, but the interesting dynamics between ASML and the inflationary story in the Netherlands as well. There's plenty more to digest because what she was just talking about is not just a Dutch story. It is broadly European, I would argue global as well. In fact, coming up after the break, new data shows that a UK recession is looking increasingly likely. We hear from Holger Schmieding, Berenberg's chief economist, joining the program next. Stick with us. This is Bloomberg.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome to Bloomberg Markets. I'm Kriti Gupta in London. Let's get to the latest economic data out of Europe. New activity surveys showing that a recession in the euro area may be looking increasingly likely. Bloomberg's Zoe Schneeweiss is all over the numbers. She joins us now from Frankfurt. Zoe, walk us through what we learned today.
So we got flash PMIs this morning from Germany, France, and the euro area itself. All those numbers have been bad for months, and this month, November, was no exception. The important number to look at here is 50. Any reading above 50 will be growth, and readings below 50 are contractions. And here we had another set of contractions. In Germany, actually, the number did tick up a little bit, but still clearly in that contractionary area. Similarly, in the euro area, slight uptick, but still contraction. France actually stayed the same, so all of those economies are in trouble. So Germany, we actually know from the Bundesbank, from German central bank, that Germany is likely to be in recession already. France had third quarter growth. So even if this fourth quarter should be bad, and the PMI numbers suggest that it is bad, France isn't in that situation yet. Now, the one that's really curious here is the euro area. Euro area contracted 0.1% in the third quarter. Now, the fourth quarter, the European Commission last week told us that they were expecting growth, but the PMIs today would suggest that actually won't be the case, which would mean that the euro area is in recession, and that actually is, of course, a problem for the ECB here in Frankfurt.
Well, Zoe, that's what I was going to go next. In terms of the ECB, they now, I wonder, are perhaps going to be following the Federal Reserve's lead in terms of what feels like a dovish pivot, or at least the markets are interpreting that. To what extent does this data really change that narrative? Do you see anything in the pricing?
In the pricing, we haven't really seen much of a change. The ECB, after a record tightening spree of 10 consecutive rate hikes, last month finally paused. They have said, and we just had Bundesbank chief Joachim Nagel say again that they can't exclude another hike. But markets don't really believe that, and markets indeed believe that there will be a cut as soon as April. So that's also something that both hawkish governing council members like Joachim Nagel, but also more dovish ones have pushed against, saying it's just too early to discuss cuts. But if there are very bad very bad GDP readings, that might change the narrative, and that might actually have some of the governing council members themselves say, okay, we need to start talking about cuts.
And Zoe, a final question to you. As we talk about that cuts, how much of it is really in response, maybe not to the broader euro area, and I know they will probably never go on record to actually say this, but perhaps isn't a response to some of the issues you're seeing in Germany. For so long, we've been talking about whether or not it's the sick man of Europe. Is Germany, Zoe, not only the sick man of Europe, but is the fiscal crisis that you're seeing there putting even more pressure on the ECB? Walk us through that dynamic.
It's obviously very bad news for the euro area if its biggest economy, which has been the driver of growth for so many years, is doing badly. That said, the contractions in Germany have not always led to contractions in the entire euro area. So the issue also here is that sick man term is one we obviously like to use. It evokes all kinds of images. The difference to when we used this in the 90s is that this time the labor market is holding up. When we used that in the past, it was after the reunification of Germany, when there was mass unemployment, there were issues here. Now unemployment is actually very tight. Employment is very tight, and that means that that sick man moniker isn't quite as apt. Both politicians and central bankers have been quite strong to push back against that. Of course, for the euro area, it does mean that there's an issue here, and it's something that they all keep a very close eye on.
Something that, of course, we know you'll be monitoring very, very closely. Bloomberg's Zoe Schneeweiss joining us there from Frankfurt to walk us through those European dynamics. But I want to get a little bit more insight here and bring in our next guest, Holger Schmieding, chief economist at Berenberg as well, joining us on this holiday in the U.S. at least. So, Holger, welcome to the show. Expand a little bit on what Zoe was just talking about. Germany, which, to be fair, is the largest economy in Europe, having all of these issues, but they still seem to be faring better than some of their other counterparts in Europe. What do you make of the fiscal crisis you're seeing in Europe?
Well, first of all, Germany definitely is not the sick man of Europe. It was in the 1990s when it had record unemployment and a worse fiscal position, at least in terms of the deficits in the end, than, say, Italy. Now, Germany has one of the strongest labor markets among all advanced economies. It has by far the best fiscal position among almost all advanced economies. That is, Germany is in a situation where it can deal with a number of short-term issues it does have. And as to the PMI releases this morning, I would put a bit more of a positive spin on them. Yes, Germany is in a mild recession, and for the Eurozone, we probably will see a contraction in fourth quarter GDP as well. Having said that, these PMI readings were less bad than they were for the month before, and especially in Germany, which was kind of leading the downturn. German manufacturing, heavily exposed to China, to global risks, is actually the downturn easing there. So the numbers do suggest that right now, fourth quarter is probably the bottom, and that the downturn will give way to stagnation early next year, and then probably to an upswing over the course of next year. So I would say the data support the call that we are at the bottom. From now on, things will get a little better. Having said that, the European Central Bank, of course, is still far too optimistic in its calls for growth over the winter. The ECB almost certainly is at the peak in rates.
Holger, I have to say, it feels like you're the contrarian in that call, but walk us through what actually supports. Let's broaden it out from Germany specifically. We'll talk about the euro area broadly. What keeps that momentum going? You said that the ECB at the end of the day is too optimistic. Well, if we're going to see perhaps moves from a kind of horizontal perspective, not major growth, but not major deterioration either, what holds the euro area stable? What part of the economy?
Well, we have seen a serious downturn in manufacturing, And we have then seen the bad news from manufacturing, the inventory correction in manufacturing, the period where companies produce less than they sell. We have seen this bad news then spreading to consumer confidence and to demand for services. What we are now seeing is that the inventory correction in manufacturing is sort of starting to fade, especially in Germany, which is often kind of a leading indicator for the overall Eurozone. So the source of the problem, inventory correction in manufacturing, is easing, and it's likely that then a few months from now, we will also see consumer confidence finding a bottom. We already have the situation that consumer incomes are rising faster than prices are increasing, so the purchasing power is going up. At the moment, consumers are saving because they are unhappy about the overall situation. But come Easter, when manufacturing will likely be on the rebound, consumers will probably notice the overall situation is not as bad anymore and will then probably add to the overall upswing by opening their purses more. And on top of that, despite the German fiscal concerns across the Eurozone, we do have a modest fiscal stimulus, which will likely support demand. And in Germany, I trust the government to find a few ways to dampen the impact of this court ruling on fiscal policy.
It's a really interesting dynamic, especially when you're talking about a potential cut going into next year, but that requires some sort of massive deterioration for even the ECB to change their tune. I would want to remind our global audience, both the Federal Reserve and the ECB, neither one of them have actually admitted to this dovish tilt. Holger Schmieding of Berenberg, I wish I could pick your brain for the next hour. Sadly, we have to leave it there, but we thank you so much for joining the program. Still ahead, how do you price in the dynamics that Holger was just talking about? Brooke May, managing partner at Evans May Wealth, is going to join us next. She's going to talk to us a little bit about that long-term positioning, not just here in Europe, but around the world when we don't really know what a dovish pivot actually looks like. Meanwhile, if you look in the markets, a really interesting dynamic here, hopping into, I want to say the currency space, but you can see it in the future space as well. S&P futures amid very, very light volume, virtually unchanged, 45.57 on those, 45.71, excuse me, on those contracts. Bloomberg Dollar Index notably weaker as well, down about 0.2%, even in line with Treasury futures, pushing the European currencies higher. We're going to break it all down for you next. Stick with us. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today. NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
We promised to halve inflation, and we have halved it. Headline inflation will fall to 2.8% by the end of 2024 before falling to the 2% target in 2025. OBR expects the economy to grow by 0.6% this year and 0.7% next. After that, growth rises to 1.4% in 25, then 1.9%, 2%, and 1.7% in 28. We reduce debt, cut taxes and reward work. I will therefore increase the local housing allowance rate to the 30th percentile of local market rents. This will give 1.6 million households an average of £800 of support next year. I have decided to freeze all alcohol duty until August the 1st next year. That means no increase in duty on beer, cider, wine or spirits. I'll invest a further £500 million over the next 2 years to fund further innovation centres to help make us an AI powerhouse. I'm going to go further and cut the main rate of employee national insurance by 2 percentage points from 12%. That change will help 27 million people. It means someone on the average salary of £35,000 will save over £450. The economy has grown. Rather than falling as predicted, real incomes have risen. Our plan for the British economy is working, but the work is not done.
That was UK Chancellor of the Exchequer, Jeremy Hunt, announcing a stimulus package worth $26 billion in the run-up to the next election. Look, there's a lot to digest in terms of the fiscal conversation around the world. The UK is just one part of that story. Of course, continental Europe is another. I want to bring you some headlines here as we get those ECB minutes crossing the wire. ECB members basically seeing more economic uncertainty now than they did in September. They're publishing their account of that October policy meeting. At the same time, we are actually getting some headlines from the Irish Central Bank chief as well, speaking in Dublin. He's saying we are near the top of the hiking ladder, saying it's too early to discuss cutting rates altogether, but you can't rule out another rate hike. I thought his specific commentary was quite significant here. Not only is he saying that this is basically not going to happen anytime soon, but he's saying that another hike may actually be on the agenda. Let's get a little bit more insight here. Marcus Ashworth of Bloomberg Opinion, who knows everything about all things rates in both sides of the English channels. We welcome you. No pressure here at all. Is he right? Is the Irish Central Bank chief right that another hike may still be in the works for the ECB?
No, and he knows he's not. He's just having to say it because they don't want to get too into the conversation about when the first rate cut comes. There is absolutely no way the ECB will hike rates again. They simply can't. You know, as they're pointing out, there's more uncertainty in September. Since they last looked at it in September, obviously the world is in a much worse place. Steadily, they're slipping into recession across most of the euro area. Inflation's come down sharply. There is no justification whatsoever for another rate cut. He knows that, but it's all about trying to make sure they don't get pushed into a rate cut before they are comfortable with. But that will happen sometime, probably in the first half of next year, I suspect. Certainly the pressure will build by then. And it'll be a question of when they decide to finally go. But normally they leave it too late. and then do too much. So we will see. But I think, as far as the PMIs has come out earlier, we do see some signs, as Holger was saying earlier, that maybe, the worst is over for Europe, and the sense that it's stopped going down anywhere. Now it's sort of bumping on the bottom, particularly in manufacturing. So it's not all gloom and doom, but I don't think it's anywhere close to being thinking about another rate hike. They've got to see how much more this monetary tightening has affected. It's clearly collapsing bank lending and money supply and all the rest of it.
Well, to your point, I mean, that's exactly what the ECB is actually saying as we get more headlines rolling out from that policy minutes discussion as well. They're saying that there's clear evidence that policy is working as intended, but most of the impact of past hiking has yet to materialize. Marcus, what does the lag look like for the ECB?
Oh, we just don't know, and no one ever knows, and that's the whole point. But they know that probably, should we guess, and something like a third of it's come through. They don't know. The point is that it's having absolutely clear effects, as I mentioned before, on bank lending, and evidently, manufacturing is collapsed, particularly in Germany and France. So, there's not a lot of hope out there, but, the economies are essentially flatlining, but I actually think they're in recession really in Europe, and I think the ECB knows that. But, nonetheless, there is some fiscal stimulus still to come through, which may keep it from being too dramatic a recession. But I think recession is for sure happening.
It feels like we're at a almost deja vu moment, Marcus, where we look at some of these central banks and we say, well, for a second there, we were all on the same page in terms of pausing rates for a second. But now it looks like maybe even going into 2024 and the meetings we have, I believe the week of December 11th as well, you're starting to see a little bit more policy divergence. The Federal Reserve taking a decidedly dovish tone, as we saw in the minutes earlier this week. The ECB likely following their lead, as you point out, basically saying there isn't any more room to hike. The BOE saying, well, maybe there still is. It feels like Andrew Bailey really sticking to that narrative. It's not the first time we've been here where he's the most hawkish central banker in the room. Marcus, do we start to see that divergence form again?
Maybe. I think the point is that the US is a much stronger fiscal and financial situation than Europe is. The UK is in a not dissimilar situation in Europe, marginally better perhaps, but I don't know what on earth is going on with the Bank of England, because Bailey's saying one thing, then he's saying another. Pill has come out and being quite realistic, saying the market pricing is probably fair. But that's not the message that the central banks are trying to sell us constantly, that it's not even time to start talking about rate cuts and maybe there's another rate hike left in it. It's all performative nonsense. They know it is. They're just trying to buy as much time as possible, hope and pray the economy doesn't collapse in front of their eyes, which I think it will start to weaken further, as I said, into the first quarter next year, and that will change the dynamic clearly. And they need to be very careful how much quantitative tightening they do, because this monetary effect is yet to fully show its full shape, but we're seeing, inflation's fallen away just as quickly as it went up. So in that sense, I think they've done enough. I think they know they've done enough. They're just trying to buy themselves some time, but no one's buying it in the markets. We're all expecting a rate cut sometime in next year for sure.
Which brings us to the question of what the markets are actually pricing in, because Marcus, when you look at some of the pricing here, the fact that we're seeing such a dovish pivot from the dollar, seeing some of these massive trading unwinds in terms of these like dollar long positions for against a lot of Asian currencies, it's creating this tailwind under the euro and the cable rate. I feel almost silly talking about just how weak the European economy is when we're looking at a euro dollar at 109 and a cable rate of 125. Is that a massive market disconnect, or am I missing something here?
Well, no, it's all literally always has been and always will be about the dollar. And so where the euro is, where the pound is relative to the dollar is sense that it's powerless. So you may see a stronger pound or euro. It's not up on its own merits. It's just down. The dollar's down. That's good for the world. I think what we have to understand, it's even good for the States. A weaker dollar is what everyone needs. Emerging markets particularly. Look how weak the yen's been. China in particular. So that's the other interesting thing when you look at the euro. If you take it on a trade-weighted basis, you strip out the dollar, it's actually very strong. And particularly against China, its biggest sort of export market. So, in a weird way, a strong euro is definitely happening against a lot of the rest of the world. It's just not necessarily showing up quite so much against the dollar, though currently it's showing a bit of strength. But as I said, it's just purely down to dollar weakness.
It's interesting as we talk about that as well, because we are seeing, as part of the policy minutes, they're actually saying that a weakening euro headwind, is a headwind to fight against inflation. So the strength of it perhaps actually helping them a little bit. They are also saying they're arguing to keep the door open for possible future rate hikes, which again, as we talked about with you, may or may not actually materialize. They're also saying that the talk of any early end of PEP reinvestments are seen as premature. Marcus Ashworth, plenty to digest there, but sadly we have to leave the conversation there with you. We thank you so much for your insights this morning. Let's talk a little bit about positioning here. Brooke May, managing partner over at Evans May Wealth, joins the program. Brooke, Marcus basically just threw a ton of cold water on this hiking narrative that we're seeing here in the ECB, but arguably in the United States as well. What is your positioning going into the kind of market narrative that you hear?
Hello, how are you? Thank you for having me. We really, as we look out, think that we're in line with consensus for the first half of the year. We think the Fed is going to be on hold, but a 25 basis point increase in June or July, we think isn't probable. We're looking out to the second half of next year before we see rate cuts. And from there, we think that we'll continue to see cuts based on how the economy is doing.
But what kind of deterioration might we see for those cuts to actually materialize? Because it feels like this higher for longer narrative has not only been here for a while, but it's being met with resilience in the economy. Even if we don't see growth, we are seeing stabilization in the United States. For a cut to actually happen, it feels like it has to be in response to some sort of data point or some sort of wage price spiral or something along those lines. Where do you see the weak point in America's economy?
Well, the Fed has a dual mandate, price stability, but then also maximum employment. So once we see unemployment start to tick higher, we think that's going to be the signal for the Fed to start cutting rates. Once unemployment ticks higher, it typically can turn pretty quickly and then exacerbate a slowdown in the economy. So that's what we're looking for to signal rate cuts are coming.
So how do you position for that? Does that simply mean you're in the bond bull camp?
We are. We have been equity biased for 15 years. It didn't make sense for us to allocate to bonds at 2% if we could get a 2% dividend stock with potential appreciation. So we've been very light on bonds for a long time, and we're starting to increase those allocations. We think that interest rates have peaked and started to come down, and we may not see 5% again on the 10-year Treasury. So here at 4.5, 4.6, we're locking in corporate bonds and then also municipals. Right now on a muni, a high-quality muni, you can get about 4.25% federally tax-free. The tax equivalent yield on that is over 7%, which is attractive to a lot of investors.
Well, it certainly almost paves the way for some of the yield hunt that a lot of people were looking for in even emerging markets or commodities as a way in kind of a zero yield environment. Brooke, come back to the part of the dividend stock that you were just talking about. When we're talking about the earnings story and the stock market, it still feels like some of these companies, big tech in particular, posting some very, very strong earnings. Even though you are decreasing your allocation to them, at least as you just laid out, do you think you're missing out in terms of entry points specifically for big tech?
While we are shifting somewhat to bonds, it's not significantly. We still like equities, but we think you have to be very selective right now. Well, you can't just buy the broad market like you could the last few years. So we're looking for companies that have very strong balance sheets, good free cash flow, and low leverage in this environment. But we do like equities. We like the big tech. We think that it's one of the best places to be for the foreseeable future.
All right, our last 60 seconds here. Where in big tech? Do you have any names for us?
Well, we like all the Magnificent Seven, but in addition to that, we like companies like Netflix. Their earnings report was stellar. When we look at where the company's changed, they went a few years ago from being growth at any cost to now profitable growth, and it showed up in the earnings. They beat earnings by quite a bit, but what was really most impressive was their net subscriber growth. The street was expecting around 6 million net new subscribers, and they had 8.8 million. And really that's attributed to a few factors. One, their ad-supported tier is growing, but also they've got superior content to a lot of their competitors. We think that they're going to be the dominant player in that space for quite some time.
It's certainly, I think, something that people are kind of grappling with here. You're seeing some of these good numbers, but do you actually hop in now? Brooke May of Evans May Wealth, we thank you so much for your insight right now. Of course, the conversation cut too short there, but there is plenty to digest, especially when she's talking about whether or not this is the right entry point. I'll give you the bull and the bear case. The bull case, simply these numbers are extremely high. And if you actually were to look at the valuations of some of these companies, people would argue, if you looked at the valuation of, say, even Facebook, back in the day when Facebook IPO'd, it wouldn't make sense, but then you would have missed out on Facebook. That's what the bulls would argue. Let me give you the bear case as well. Simply the fact that because of their cash flow and this inflationary environment, suddenly it as a liquidity play in terms of a trading vehicle, basically, it doesn't hold that same appeal in the way that a bond market might. Lots to digest here in line with some of the developments we are getting in the OpenAI story. The return of Sam Altman to the founders of OpenAI. We hear the reaction from early investor Vinod Khosla coming up next. This is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we presented with a plan.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome to Bloomberg Markets. I'm Kriti Gupta in London. It certainly has been a whirlwind past week for Sam Altman and OpenAI, where he was fired, then hired by Microsoft, and then rehired again as CEO over at OpenAI. Bloomberg Technology's Ed Ludlow spoke about the turmoil with the founder of Khosla Ventures, Vinod, who was, by the way, the first venture investor in OpenAI. Take a listen to what he had to say.
I'm very happy to see Sam back. He's uniquely positioned for stewardship of this very important company. It's much more than just a company. It is benefit of AI to humanity in a much larger way over the next few decades. And I think we've restored the path.
Mr. Khosla, you outlined a thesis that when the board on Friday, or the board as it was then on Friday, fired Sam Altman, they set back artificial intelligence. Why was that the conclusion that you reached?
Mostly because Sam is uniquely qualified to shepherd this, and he has a vision over the next decade or two of what AI can do. I can't imagine somebody else being able to step on those shoes easily and without a lot of risk to the mission of what OpenAI was.
Vinod, when I posted on X that you were coming on the show, there was a lot of interest. You were the first venture investor in OpenAI, and there was a very specific question posed for you, which is, and forgive the framing of the question, but this is what the audience asks. What happens if Sam Altman gets hit by a bus? What happens if Sam Altman is discovered to have had some wrongdoing. What happens to OpenAI in that scenario?
There are other people at OpenAI who are very qualified to do that. Greg Brockman would be among my favorites in the current OpenAI team. And I think they should de-risk this by adding more people to the team who can step in. But if he does get hit by a bus, I think we would have to do with Greg Brockman, who is very much of the same vision and mission.
Vinod, what we're talking about, I guess, is key man risk. And just as you have, I've been reporting on the story since Friday lunchtime, considering what's happening. But the takeaway has been that the value of OpenAI appears to be the intellectual capital, right, of its people. And when Microsoft reacted to the news, the idea was in the kind of mutiny that was going on that those people would simply go and join Microsoft. And I wondered what you thought about that eventuality, which to some extent now is academic, but there is still a close tie between the two.
I think the close tie helps make progress in AI because it needs a lot of resources. And frankly, I'm very pleased that OpenAI is there, Google is there, and there's at least two major efforts, a few others credible efforts in the AI industry. So I do think Microsoft supporting OpenAI really helps it move it along, give it the resources Google has internally. And more competition is generally a good thing. And more AIs will make progress move faster. So I'm very happy with that. I won't comment on OpenAI team becoming a part of Microsoft AI. I always believed we would find a resolution. It was only a matter of time. So I had complete faith in this solution. In fact, my conversation with Sam around noon on Friday, when this first was announced, is I don't think it's over, was my first comment back to Sam.
You didn't think it was over Friday lunchtime. It seems like an eternity ago that it was Friday lunchtime when the headlines broke. I mean, it is an issue of the board and corporate governance, right? And what we know is that Brett Taylor, at least on an interim basis, joins the board along with Larry Summers. For our audience, Larry Summers is a paid contributor of Bloomberg Television. And then my understanding is Adam D'Angelo stays at the board. To your mind, as an investor in this company, you know those names in Silicon Valley. Is this addressing the corporate governance question enough?
I've been on a board with Larry Summers at Square, or now called Block, and I admired Larry. I think over time, the board will build up to more governance, and I think 3 is a small board, but over time, there'll be more governance and better process. I think we've learned an important lesson on governance here. And frankly, I didn't, in my remote imagination, imagine that something like this could happen or the board would do this. There were some errant people on the board who misinterpreted their own religion around EA or effective altruism.
Vinod Khosla there speaking to our very own Bloomberg's Ed Ludlow. Of course, you know Vinod is also an investor in OpenAI alongside a massive slew of other major names. Bloomberg's Alex Webb knows them all by heart. He joins us now to continue the conversation. Alex, no pressure there. Let's talk a little bit about Vinod's response, your take.
Yeah, firstly, let's take that as a granted that I know the names and don't ask me to recite them all.
It's about to.
it is interesting that, his attitude towards it, the proximity to Microsoft, he sees as a good thing. The challenge is in this space that you need lots of resources, monetary, but also in terms of compute power in order to build and train these large language models. It is something that Google has, or the DeepMind, which is Google's AI research arm, it has access to all of Google's powers in that. The difference is with OpenAI, it is not owned by Microsoft, as we know all too well from the events of the past week. The structure of OpenAI is very complicated. Its board is not beholden to any investors. Its mandate is to work in the interests of humanity. So that's where things start to get a little bit complicated with what was essentially founded as a nonprofit.
Yeah. Walk us through where in that board structure Microsoft's 49% stake falls.
Yeah, so in as simple a manner as possible. So at the very top, you have this board, as I said, beholden to, genuinely in the founding documents, it says to humanity.
Yeah.
Below that, you have a holding company in which investors such as Khosla Ventures, but also the employees have a stake. That in turn owns or controls the operating company. Now, Microsoft has a 49% stake in that operating company, not in the holding company.
Right.
It therefore historically has had no say, direct say at least, in the running of OpenAI. The truth is maybe a little bit more complicated than that, given the fact that they are dependent on Microsoft for so many resources. That is also why when we saw, for example, on Monday, Satya Nadella, the Microsoft CEO on Bloomberg TV, he said he was seeking governance changes. The read on that is that he wants board seats. It has now been reported by Bloomberg that Microsoft is likely to get some board seats. They might just be observation seats, but at the very least, it would mean that Microsoft is not going to be surprised if there is another attempt to oust the CEO.
Yeah.
I hope that sheds some light on the matter.
It definitely does, and I think what's interesting is not only are they vouching for a board seat, but who else is on their board as well. Ed kind of walked us through a little bit of it, but Brett Taylor, for example, not only was he the chairman over at Twitter before it became X, but he was the co-CEO of Salesforce. He's on the board of Shopify as well. Adam D'Angelo, the CEO of Quora. There are some pretty heavy weights here, including even, I believe, in the effort to make a little bit more of a diversity and inclusion push. They're looking for some pretty senior women in Silicon Valley as well. What does that tell you? There's been some speculation, at least, about whether or not kind of stocking the board up with those kind of names, including potentially Satya Nadella or some other Microsoft representation, would push OpenAI to be more than just a nonprofit.
Yeah, I mean, it certainly looks as though that is a bit more the direction of travel. I think the challenge was with the composition of the board previously that it was relatively small. Essentially 4 people voted out Sam Altman. We're looking now for a board that could be 3 or even 4 times as big as that. It is seemingly going to be leaning more on the sort of Silicon Valley luminaries that typically, consist of the composition of these boards. It had lost a little bit of that heft over the past few months because Reid Hoffman used to be on the board, the founder of LinkedIn. He had dropped off in order to found his own AI startup, which probably is going to be competing. So the board consisted of really just one external business figure and 2 academics. And that some have seen as maybe a little bit of a problem. Might also have been why this kind of coup attempt didn't work very well because the strategy didn't seem terribly well thought through. It was very rushed, and in the end, it didn't work. Like Samuel was back through the door.
Yeah, it's a really tricky situation. I wonder now that he is back, what kind of changes he actually will make. Alex Webb on the top of all of that coverage. We thank you so much for walking us through. And I should say, as he mentioned, even the DeepMind piece of the equation, there was a trade afloat as this was all happening where Microsoft and Alphabet shares were essentially pitted against each other as major competitors. So that's going to be your market trade to watch as we see this continue to develop. Coming up on the program, Paul Christopher of Wells Fargo Investment Institute joins us next. We're going to get his take on how you trade all the drama in the macro and the micro. Stick with us. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From business's most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Welcome to a special edition of Bloomberg Markets. I'm Kriti Gupta, live from London. Now, U.S. markets are closed for Thanksgiving, but we are here with you today. And of course, happy Thanksgiving to our global audience, if indeed you do celebrate it. In the meantime, let's get a quick check on markets, because even though U.S. markets are closed, European markets are alive and well. I want to start with futures trading, though, because of course that trading continues. 45.68 on those futures contracts, virtually unchanged. Again, extremely light volume, so not exactly that surprising. In the meantime, you are seeing a bid into at least bond futures. Remember, the actual Treasury market is closed, but the way international players can actively trade it is through these commodity active contracts, basically. That's down by about 2 basis points. So again, seeing a bid into the bond market, which I think is pressuring the dollar as well. Bloomberg Dollar Index down about 0.1%. Interesting, though, that Brent crude not really responding to that dollar weakness. It is also lower by about 1%, trading at an 81 handle. Meanwhile, right here in Europe, a little bit of a different picture, because even though, again, very light volume, some of that's simply coming because you don't have those U.S. counterparts to trade with at this time, you are seeing the stock 600 higher by 0.1%. The FTSE right here in the UK is underperforming, though, down by about the same margin. That Bloomberg Dollar Index weakness that I was talking about, though, reflecting in an interesting way when it comes to the currency picture. Euro dollar hovering at about 109, the cable rate at about 125. So again, a lot to digest there in terms of the currency moves. Let me bring you some of the breaking headlines we are getting, not necessarily in G10, but in the emerging market space right now. We are getting numbers coming out of South Africa. Their Reserve Bank seeing inflation averaging at about 4.5% in 2025, about 5% in 2024. So again, they are putting out their kind of forecasts for the next 2 years or so. We are still waiting to actually get a little bit more context on what those core numbers actually look like. But for all you need to know right now is it's not necessarily moving the markets that substantially, especially when you look at the South African rand. Again, remember, the inflation readings don't always move the currency to that extent. The liquidity story in that currency pair is something that we watch very closely, especially against other emerging markets in terms of how much exposure you actually want. But when we get more information around that decision, we will bring it to you. I want to stick with the emerging market space, though, because, of course, we've had some major news in the last, I want to say, 2 weeks or so, and some major players in the EM space commenting on it. Mobius Investment Consulting President Mark Mobius says that dollarization will be a huge boost to Argentina's economy. And he also talked about China as well. He says he prefers it in terms of investment lens rather than Taiwan. He spoke earlier this week on Bloomberg Markets. Take a listen.
If you go into a place like Argentina where there's inflation, we were investing at one point when it was about 2,000%, and it was very, very difficult. We had to buy companies on the basis of their book value rather than anything else. But at the end of the day, it's been a very dangerous place to be with the currency the way it is and with inflation in that situation. So now, if they dollarize, that's a big if, by the way, if they go ahead with that, it will be an incredible boost for the economy and for the country. You'll see inflation come down dramatically. If they get rid of the central bank, that'll be another step in the right direction. And I think the outlook is terrific under these circumstances, but we have to wait and see if the new president can actually implement those changes.
Mark, good afternoon. Are there enough dollars to do that?
Yeah, there's plenty of dollars. It's not a matter of the quantity of dollars. It's a matter of pegging the economy to the U.S. dollar, because Argentine people have lots of dollars offshore. You better believe that they protected themselves from this incredible inflation by having dollars. So there's plenty of dollars. And it's a psychological impact, which is so important. It's not a matter of them, using dollars every day with cash transactions. Nowadays, with paperless transactions, as long as you're pegged to the dollar and everything, all the prices are pegged to the dollar, then you're going to see an incredible return of confidence.
What about others? If you're looking at, say, China, for example, which has raised a lot of question marks in terms of the fragilities in that economy, the trajectory of it, is that somewhere you see opportunity or danger?
There are opportunities in China. It's a huge market, as you know. It's a big economy. But we think it's a better idea, if you want to look at China, look at it through Taiwan. Because you must remember, there's a lot of trade that takes place between Taiwan and China. Many Taiwanese companies are in China. Of course, Foxconn is probably the best example. Maybe not a good example at this stage of the game, but there are many, many companies like that. So we prefer to go into China through Taiwan, particularly now with the incredibly increased emphasis in China on technology, and particularly semiconductors. As you know, TSMC, Taiwan Semiconductor Manufacturing in Taiwan, is the leader in the world in high-value semiconductors. So that's where we want to be.
Mark, you're not in any way concerned, therefore, that we do see geopolitical tensions around the island being raised. There are many people that are concerned that 2024 could be the year in which we do see tensions being ratcheted higher. There's even some talk of an embargo. We don't know what's going on in the mind of the senior leadership in Beijing. You're confident enough that we're not going to see any trouble, that we're not going to see that kind of an event presenting itself in order to make those investments?
I feel that there's not going to be anything happening in the short term. When I say short term, I mean the next 2 or 3 years. And the reason for that is China is not going to benefit from a military invasion of Taiwan. In fact, they won't get what they want. They want a handover which is peaceful, where they can take over and begin to benefit from the companies in Taiwan. And if you have a hot war, that's not going to happen.
Mobius Investment Consulting President Mark Mobius there with Bloomberg's Kaylee Lyons and Guy Johnson, talking a little bit about just how he actually plans on playing some of the emerging market space. I want to turn back to the markets and maybe push that question to our next guest. He says high rates and inflation uncertainty will lead to volatility that isn't going away anytime soon. Paul Christopher, global market strategist over at Wells Fargo Investment Institute, joins us now. Paul, a pleasure to have you on the show. Happy Thanksgiving to you and to your family. Let's talk a little bit about this way this market functions, because emerging markets used to be such a attractive play in a kind of zero interest rate environment because there was no yield to be had anywhere, so you had to take on that extra risk. Now it feels like that trade is really pared back for those macro investors that are maybe hopping right back in to traditional G10 markets and not taking on that extra risk premium. Where do you stand in terms of that call?
So it comes down to liquidity, really, Creedy. If you have a lot of liquidity being pushed out the door by the Fed and the G20 central banks, that liquidity will find a home, and then you'll end up seeing a lot of money go to emerging markets simply because of the yield differential. And if the rest of the world is growing, then you'll see some dollar weakness, and that will make it even easier to go into emerging markets. But never mind, even if you set aside the geopolitical piece of it, now we don't think the Fed goes back to that. We don't think QE is in the cards anytime soon. That means the liquidity is going to be harder to get. And so emerging markets are going to struggle a little bit more to find that capital. And without that, you're really better off, we think, sticking in, especially if you're a dollar-based investor, you're better off sticking in the U.S.
So let's go there then and talk about the future of the dollar, because it feels like, at least from a currency perspective, there seems to be kind of a race to the bottom if we can talk about which central bank is going to cut the most and fastest and therefore weaken their currency even faster than that. Your dollar call, Paul.
Our dollar call is that that race is sort of on hold. What you're seeing in the dollar now is some give back of a very steep run up that we saw in the last several months. But I wouldn't get too excited about that just yet. We don't think the Fed is ready to cut right now, and that's gonna do some things to keep the dollar, let's say, a little bit stronger for longer. It may give back some of the latest push higher, but don't expect broad weakness in the dollar anytime soon. That's probably maybe a 6 to 8 month call into the future. We need to get past this period of U.S. economic weakness first, and then we can talk about what happens to Fed rate cuts and then to the dollar.
Well, talk to us about the economic weakness then, because I think one of the big kind of calls in terms of shorting the dollar long term is not just the monetary policy anymore. It's actually fiscal policy, and specifically the fiscal deficit going into 2024 and arguably 2025 as well. Paul, one of my favorite fun facts of this conversation is that as soon as the presidential election is over in 2024, whoever the new incumbent president is, whether it is Joe Biden or any of his kind of GOP adversaries, the very first thing they do, January 2025, is deal with the deficit again and the debt ceiling. Paul, is that a reason to not buy American assets going into the next 2 years?
No, not at all. But you need to have the economy turn higher first. I think it's almost inevitable that they're going to come up with some sort of a deal in Congress. Yes, we're under another continuing resolution right now, but if they don't do anything, they see the budget cut by 1%, and that's going to be a difficult thing, especially in defense, for some of those hawks in the Congress to deal with. And so what's always happened in the past is that they've come to an agreement, some sort of a compromise, where spending is higher than the previous year's level, but maybe not as high as some people wanted it. And at this point, that's important because the CBO, the Congressional Budget Office, already sees $1.5 trillion deficit for each of the next 3 years. And if you add on top of that with a budget deal for 2024, and to your very good point, another one in 2025, that's going to increase the size of that deficit. And I won't talk about bond vigilantes, but it may cost the Treasury a little bit more to issue debt. And by the way, don't expect them to just simply issue Treasury bills forever and ever from now on to avoid having to pay higher yields. They're going to have to go with some of those longer term, longer duration sorts of assets. And so bottom line is the Congress hasn't fixed the problem yet. And so the economy is going to slow down here so soon. And so you're starting to see yields fall a little bit. But to your very good point, again, we will see this problem be revisited. It's not one that derails markets, especially if we're in a recovery, but it's one that in the meantime, between now and let's say the middle of next year, is another one of those factors that we think is a headwind for investors and really should keep the focus on quality in the U.S. markets.
Paul, a final question to you, because you mentioned it at the start of the segment, is the liquidity story. If you're talking about this extra issuance and this extra supply conversation, perhaps affecting the market decisions in the long term, let's talk about the short term and the lack of digestion that we've seen in the bond market. Does that concern you at all when it comes to just how much liquidity is actually offered in the bond market?
Yeah, that's exactly right. I mean, the 10-year Treasury was at 5% just a few weeks ago. Now it's lost 50 basis points in a very short period of time. That's a big move. And why? Because the Treasury is issuing shorter-term debt. Can they do that forever? Yeah. No, they can't. So we're going to have some sort of another reason to buy stocks. We think that comes after this slowdown is over, probably into the second half of next year. And at that point, you might have a really good opportunity to buy stocks broadly as well as treasuries.
It's certainly something we're going to keep a very, very close eye on. Paul Christopher of Wells Fargo Investment Institute, we thank you so much. And of course, wish you and your family a very happy Thanksgiving. In the meantime, to our global audience, we are getting some breaking news here. The South African Reserve Bank leaving their benchmark rate at 8.25%. The estimate there was also 8.25%. So essentially holding their rate on hold. And the decision was unanimous from their Monetary Policy Committee. On those headlines, though, you are seeing some weakness in the South African rand, not only against the dollar, but against all of the major G10 and emerging market currencies. So again, some weakness on the fact that the rate decision was actually on hold as the markets largely expected. Coming up after the program, we're sticking with the EM space. China may allow banks to offer unsecured short-term loans to qualified developers. What does that actually mean? We'll have all the details next with our very own Tom McKenzie. Stick with us. This is Bloomberg.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Welcome to Bloomberg Markets. I'm Kriti Gupta in London. For the first time, China may allow banks to offer unsecured short-term loans to qualified developers. Country Garden and others surged on the news. Let's walk through it and kind of figure out what it all means. Bloomberg's Tom McKenzie, our resident China expert, is all over that story. So I'll put that question to you. What does that mean?
So this is the first time, if this comes through, that Chinese officials are going with a policy around short-term and, again, unsecured loans. And that's really interesting. First time they would have done this, which speaks to really their, if not desperation, then their sense of urgency around addressing this problem. So these loans, they'll be short-term in nature and they will not be backed by collateral. And the idea is that it will allow these developers, as they wrestle with these bond payments they have to make, to also ensure that they have the liquidity for day-to-day operations, because the priority from the government is to ensure at this stage that they are building out and completing the millions of homes, millions of projects across China that people have put deposits down on, because they don't want to see a social risk and a risk of protests on the back of that. They want to see these homes built. They want to ensure that these developers have the short-term liquidity to get that done, and then give them the space and the breathing room to be able to pay down the longer-term debt. And we've seen the market reaction to that today in the Chinese market, in the Asian markets. You saw Chinese developers rallying and the bonds rallying as well. So a bit of respite, at least for now, on the back of these proposed measures.
But at the core of it, it's a stimulative measure, and we know the PBOC in particular has been trying to do that in various shapes and forms, not all well received by the market. So I guess my question to you is, does this work?
Well, so far, the measures have not put a floor under the property crisis in China. You've seen about a 3-year slowdown and drop in terms of construction in and across the real estate sector of China. For the context, it makes up about 20% of China's GDP. They've done a number of things. They've put together a whitelist this week of developers, and some of the most distressed developers, that will get access to easier financial conditions, including that company that you named, Country Garden, which is one of the biggest real estate companies in China. They've also put aside and set up plans for potentially up to $140 billion US worth of funding for what's called social housing and the renovation of cities and towns across China. There's a number of measures they're pushing through. So far, again, it hasn't done enough to put the floor under the crisis, but this would be a big step in that direction. The hope, of course, is that this package of measures, when it's all put together over time, will help move the real estate sector in the right direction and rebuild confidence amongst the developers, but also amongst home builders and consumers and house owners in China, who so far have seen those property prices falling for at least the last 18 months.
What I find so ironic about the Country Garden story is that even though it is such a massive piece of the China property story as well, it's a penny stock in the market. So on the surface, it doesn't seem that significant. My favorite fact, though, when it comes to Chinese infrastructure broadly, and bear with me here, this is me nerding out, is that back in 2009, when you saw the kind of climb out of the global financial crisis, it was this Chinese infrastructure bill that actually had this global read-through in terms of commodities, et cetera. My question to you is, does this stimulus for the property sector have that same global read-through?
Well, you make a really good point, because it all goes back to 2009. It all goes back to that massive stimulus post-Great Financial Crisis that lifted not just the Chinese economy, but the global economy. And China has been wrestling with the consequences of that ever since. And the reason they've gone hard on the real estate sector in the first place, starting 2 to 3 years ago, was precisely because of the build-up of debt that was a legacy of that generosity and that largesse that came in 2008, 2009. That's why they put these measures in place to restrict these developers from extending their leverage. But the consequences of that is that you've seen this rapid slowdown in house prices, rapid slowdown in construction, and that impacts local governments. They've seen a shortfall in terms of the funding to build out other projects and spending at a local government level. It all links together. But you're right, it ties back to 2009. The hope is that they can get to a happy medium, muddle through, they address some of the debt, they get the real estate sector back on its feet, whilst ensuring that that moral hazard question around over-leverage has been addressed, at least on some level.
And something we're going to be monitoring very, very closely. I know it has a certain read-through into not just the commodity sector, but even stocks in Europe and the United States. Bloomberg's Tom McKenzie, we thank you so much for breaking that crucial story down to us. Another thing that we are monitoring, not out of Asia, but out of the Middle East, is the hostage deal coming out of Israel. Their truce and hostage deal with Hamas is facing delays, with the head of Israel's National Security Council saying that releases will not happen before Friday. For more, let's bring in Bloomberg's Paul Wallace in Dubai. Paul, a pleasure to have you on a program which feels like a truly historic moment in terms of the fallout since the October 7th attacks. Walk us through what we know about this hostage deal.
Well, as you say, Kriti, it would be a big, big deal. While Israel says this would by no means end the war and that fighting will continue until Hamas is destroyed as an organization, it would be the first significant lull in fighting since the conflict erupted on October the 7th. It's a complicated deal. It essentially has three major components. One is the release of 50 hostages held by Hamas in Gaza. Another is the release of about 150 Palestinian women and and children held in Israeli jails, and also this 4-day ceasefire. It was meant to kick in today. That was the expectation. We thought we'd have a gap of about 24 hours after the deal was announced in the early hours of Wednesday. But we're going to have to wait at least until tomorrow. Israeli officials are implying that something is going on with Hamas. They're not exactly sure what it is. There are some rumors that Hamas is trying to put in further demands before it agrees to release hostages, but we don't know. However, it is important to note that as far as Israeli public comments are concerned, and those from Hamas as well, the deal looks like it's still going ahead at this stage. We don't seem as if we're facing a breakdown, a total breakdown.
A really interesting comment that Prime Minister Benjamin Netanyahu has made in the span of these hostage negotiations is that a second stage of this could see the halt in fighting extended by 1 day for the release of every 10 additional hostages. Paul, do we have any indication of just how many hostages are left after this initial deal?
So Israel says that just under 240 people are held hostage at the moment in the Gaza Strip. So we're going to be left with about 190 after the first phase of this deal is implemented. Some of those are soldiers. We just don't know how many, and presumably they would be the last of the people that Hamas would release. It's starting with women and children, as we understand. The 50 to be freed at first are all women and children. So we still have a long way to go, and it's pretty clear that Hamas is going to continue to use those hostages as leverage to seek out certain demands from Israel.
Paul, walk us through the global reaction here, specifically when it comes to the players in the Middle East as well. There was a great piece in The Economist saying that a lot of the regional powers in the Gulf in particular also don't necessarily want to see Hamas succeed. It's, of course, an organization that has been labeled as a terrorist organization by the United States, the EU, and several other players around the world. Walk us through what the folks in the Middle East are thinking about this hostage deal.
I think that's largely true, that a lot of leaders and governments in the Middle East wouldn't mind seeing the back of Hamas, even if they're not saying that as publicly as Western countries and some of Israel's closest allies. But what they're arguing is that they say that what Israel is doing in Gaza, this massive bombardment and ground offensive, is either not going to achieve that or that it's only going to achieve it at the cost of huge numbers of Palestinian civilians. And we've already seen more than 14,000 people killed in the Gaza Strip, many of them children. That's according to the Hamas-run Ministry of Health in the territory. The other thing that they are very worried about, this is Arab states and the likes of Turkey, and to be fair, I think you can include the US in this group too, is that Israel doesn't seem to have a post-war plan for Gaza. It doesn't seem to have the military plan to go alongside its military operation, and that's a huge worry for regional players.
And certainly, of course, a dire humanitarian situation within Gaza itself, something that we're monitoring very closely. Bloomberg's Paul Wallace out of Dubai. We appreciate you staying late and giving us that update of a really historic moment, again, coming off of the October 7th attacks. But as he said, it's not finalized yet. When it is, we, of course, will bring you all the details right here on Bloomberg Television and Radio, as well as some of the commentary we're getting not only from the White House, but powers in the Gulf and Europe as well. There's plenty more ahead on this day of Thanksgiving programming. Stick with us. This is Bloomberg.
the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome to Bloomberg Markets. I'm Kriti Gupta in London. Oil prices continuing to fall after discord within OPEC Plus forced the group to delay its upcoming weekend meeting. The news coming just as U.S. data shows a pretty hefty rise in stockpiles. So how do you digest all of this? Let's bring in a true expert, Bloomberg Senior Executive Editor for Energy and Commodities. Will Kennedy joins me right here on set. Let's start with the OPEC piece of the equation first. How did we even get here? What's behind this delay?
We were expecting the meeting to happen this weekend, as you know, but it became clear yesterday that OPEC felt that it wasn't in a position to go ahead with that meeting. I think that we take from that there was some discord about what to do next, and specifically our understanding is that there's been a review of the quota of some African members, specifically Nigeria and Angola, which was agreed at the last meeting in the summer, and they don't seem very pleased with the outcome and what's being asked for them after them, and so it seems that they were refusing to sign up to what was proposed, and so the decision was to delay it by a few days so that they can resolve this standoff.
Do you foresee any kind of massive changes being made off the OPEC meeting? But to your point, even the countries that you named are dealing with even meeting the quotas in the first place?
I don't know what we can say about policy for next year right now. I think it's fair to say that it's a very fluid situation. But if we look at the context of this meeting, clearly prices had come down since early October. Demand has held up remarkably well this year, but supply is also very strong. We had the hedge fund manager Pierre Andurand on Bloomberg Television yesterday, and he pointed out that supply from the United States has been much stronger than people had expected.
Yeah.
So that's why prices hadn't quite got the traction that some expected. But as we look into next year, people are starting to think that demand growth isn't quite as strong as it has been this year, and that balances may not be that productive for prices, constructive for prices. So OPEC may have to act. We don't know what that action looks like, but I think we can take away that the Saudis have done a lot of the heavy lifting, and they may be asking other people to share the burden.
The stockpile build is where I want to go next, specifically in the United States. As you mentioned, it felt like 12, 18 months ago, even 24 months ago, we'll call it, one of the big concerns from a lot of the U.S. shale players was this idea that they didn't have physical capacity, but they also didn't have the labor and other resources they needed to actually ramp up some of their production. Have those issues dissipated now? Is that why we're seeing this build?
It seems that shale production is stronger than people have expected. It's come in really quite well this year, and I think that's due to a few things. They've got on top of the cost problems that they have.
Yeah.
Prices rose quite strongly this year until recently, and that allowed them to produce profitably. Interesting to ask whether they've managed to hedge some of those higher prices, allowing them to keep producing. And shale always tends to outperform people's expectations. I suspect it speaks to the ingenuity of the shale industry. But the question is whether that continues next year. I think a lot of people don't think that the prospects of the shale industry will be quite as bright in 2024.
It's interesting because even though we're talking about this increase in supply, we haven't necessarily seen this deterioration in demand yet. But when you look at it from a macroeconomic perspective, you look at some of these calls for the Federal Reserve and its kind of global peers to start cutting rates going into 2024. And I'm wondering if there is some sort of projection within the commodities market, which I've always felt is a much more real-time kind of indicator of where the demand story actually is, not just in the U.S., but globally. Do you see that lining up with what some of the economists and market participants are thinking, some sort of deterioration in the spring or summer of next year?
I think this is the most important question facing the oil market right now, is just how strongly demand grows next year. I don't think anyone thinks we're going to get into a position where demand falls. That only happens in very severe recessions like the COVID crisis or the financial crisis in the 2008. But when the economy slows, demand growth slows. And demand growth has been very strong this year, partly because China was still emerging from COVID. People don't see the same strength in demand next year. The question is how much it slows down. And the difference there can make a huge difference to the balances going forward next year. So I think people really want to look into the macro picture and see how strong the economy is.
Well, let's talk about how you then trade it in particular, because, again, I'm old enough to remember 6 weeks ago when we were talking about oil crossing $100 a barrel. Is 100 still the line in the sand on the upside?
I think we're a very long way from $100 a barrel now. And, I mean, I think what's interesting is that when we get in there, it's hard to make that push towards $100. And, you know, it's obviously a key psychological level, but I think it may be that it's the level where people start worrying about the impact of price on demand. That if you get towards $100, people start using a little less oil, and I think that's a concern for people. But I would say again that the reason we didn't get there is, one, people were pricing in the risk of significant disruption in the Middle East, which has clearly dissipated, at least for now.
Yeah.
Second, supply has been relatively abundant, and the growth in demand we've seen has been matched by supply, and that's happening at levels well below 100. I think that tells you something.
Well, the fact that we're looking at Brent crude at about an 81 handle, which I believe is the break-even rate for the Saudis. Correct me if I'm wrong.
Well, people measure it different ways, but I mean, it feels like 80 or higher. Yeah.
Right. But at the same time, you are seeing some weakness in the NYMEX contract as well, and there's a $5 spread difference. We're getting really nerdy here. This is what happens on Thanksgiving holiday. But Will, when we talk about the spread difference and how you actually trade oil right now, you mentioned the geopolitical situation is kind of quieting down in terms of the oil read-through, but there is still a lot of massive rhetoric in terms of Iran and sanctions against them. Can you give us a little bit more insight in terms of Iranian output moving the oil market? Is this something that should be on people's radars?
I've talked a lot in this conversation about abundant supply, and one of the biggest sources of supply in recent times has been increased shipments from Iran that have been able to both produce more and place stockpiles that are held onto the market. There's a lot of speculation about why that's happened, but many people say that it's because the US decided that it wasn't particularly keen to enforce sanctions on Iranian exports, that it was more important for them to subdue the oil market. I think if we look into next year, I would make 2 points. One, I don't think there's any additional Iranian oil to come. I think they're probably producing pretty close to their maximum. But I think we also need to think about the oil market in the context of the American election. If the Biden administration was willing to do all sorts of things to keep oil low this year, perhaps go easy on Iran, although they would deny that, perhaps go easy on the price cap for Russian oil, although they would probably deny that, do a deal on sanctions with Venezuela, you can see a pattern here. If they're willing to do all of those things in 2023, I don't think many people would expect them to do it any differently in 2024 when they're going to go into a very, very difficult election, and the price of gasoline is absolutely key to American politics.
I mean, I was about to let you go, but the fact that you brought up the presidential election, I have to ask now, you brought up Venezuela as well, and this has been a really key sticking point in some of the Biden policy agenda as well. How much do we actually expect out of Venezuela? This is a country where hasn't really provided that much output to the U.S. specifically in a very long time.
No, and I don't think it's going to be a game changer. I mean, we're talking about a few 100,000 barrels, but I would say a couple of things. First, in this situation, countries often surprise on the upside. It goes back to the ingenuity thing I mentioned with shale. Petroleum engineers, oil industry people, they're good at getting oil out of the ground when they're given the chance to do it. And, you know, there's no doubt that the Venezuelan oil industry is a pale shadow of what it used to be, but there are still a lot of people in Venezuela who know how to do this, and with a little bit of investment, they probably can, and it may have surprised on the upside, but we're probably taking several 100,000 barrels. But also in a finely balanced market, that can be enough to really make a difference. So it's definitely something to watch in the early part of next year.
For me, I think it's the corporate read-through that's so important. How much do Exxon and Chevron, which had been dealing with some of that sanctions exposure through Venezuela, have the pressure almost relieved? Will Kennedy, I won't have you answer that question. Don't worry. We thank you so much, though, for your additional context on that story. Let's get a true expert's kind of insight here and build on what Will actually was talking about there. Nadia Martin-Wiggin, director at Swelland Capital, joins us now. Nadia, pleasure to have you on the program. I want to build on what Will just outlined for us. This this output, I should say, from Iran, from Venezuela. How much should we be paying attention to it? Put some numbers on it for us.
Thank you for having me. I think it's super important, and I actually disagree a bit. I think Iran is able to produce more, maybe 400,000 barrels per day next year if they were given a blind eye. I think in Venezuela, maybe, as he says, 150,000 barrels per day. But I think the more important point, and this is when we talk about demand destruction and price, is that as Iran and Venezuela are normalized into the market, and also Russia, it means that countries like India and China no longer get a discount for that crude. As a result, it means that U.S. crude and North Sea crude and OPEC crude, when you think of a refiner buying all those crudes together, if you're not getting a discount on part of your crude slate, then you can't pay as much for the other part. And this is why I think we hit that price ceiling when we were above $95 a barrel, when you added the physical differentials of more than $100 a barrel, that we couldn't stay up there. Refiners were starting to look at cutting runs.
How much of that, and you did put a number on us for us, that 400 million barrels per day coming out of Iran specifically, 400,000, excuse me. Yeah. Thank you for correcting me. It's Thanksgiving. I want to give myself a pass there. But Nadia, I appreciate that. Let's talk a little bit, though, about how much of that can change based on the developments of the geopolitical conflict, or is that something that's more pegged to the White House and Biden's kind of election campaign? How are you thinking about that? What are the signals we need to watch out for?
Yeah, I mean, the U.S. has hinted after everything has flared up in Israel and the Gaza Strip that they won't be taking such a blind eye on Iran. Also, that the price cap to Russia will be reinforced. So in our base case, we don't expect that production to come online. However, I think we need to be prepared that that is something that could potentially come online. And when we think about this OPEC meeting, and when they're thinking about resetting all the levels, Iran right now is not subject to any cuts. At some point, eventually, if they are normalized into the market, they would be subject to some cuts. And this is why I think it's very important what happens to the underproducing nations, in terms of Nigeria, Angola, Congo, that are not able to make those numbers in terms of how we think about the members of OPEC. Venezuela as well, they're not subject to things. I think Venezuela is not going to be as quick because it requires more investment. Once that investment comes, then we can see ramp-ups of, 500,000 barrels per day within a year. But I think that that's a little bit late coming ahead of this U.S. election, because any promises made to Venezuela might not be kept if the administration changes, right? So I think Iran is really this opportunity or tricky point, and it will depend on the oil price and how things are versus how the geopolitical pressures are in terms of the Middle East.
Nadia, in our last minute for this conversation here, we talked a little bit about the supply coming out from everywhere outside of the United States. But as Will pointed out as well, we're seeing some pretty stable production coming out of the United States as well. How much momentum do you think that has going into next year?
I think we will continue to see growth because OPEC has protected this $80 price floor best they could, right? We dropped down to the low to the 60s, but still we've had long, strong prices, and OPEC has been focused on having these deep, long cuts that create stability. U.S. production will continue to be steady when we are trading above, $70 a barrel. So when we think about what happened, I think last year, one thing that confused the market is we had a shortage of personnel. We had a shortage of ability to complete wells to bring out that production. We no longer have that sort of tightness, so things can tick along. I don't think they're going to be skyrocketing higher, but we will continue to see, per quarter, an additional 150,000 barrels per day, 200,000 barrels a day through next year. At the same time, Canada is producing more because they have a big pipeline opening to China. So that is something that OPEC also has to consider, is that non-OPEC growth is coming and it's taking market share.
Certainly something that is whatever the opposite of music to someone's ear is when it comes to some of those Middle East players. Nadia Martin-Wiggin, a Swell Capital, we have to leave it there. We thank you so much for joining the program, bringing us that crucial insight. But at the core of the oil story is going to be the consumer story as well, and that's where we go next. Bargain hunters getting ready to pounce on Black Friday deals. We hear from Mark Rosen, the CEO over at JCPenney, a massive American retail department store. Stick with us. More coverage ahead. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Welcome to Bloomberg Markets. I'm Kriti Gupta in London. Guess what I'm missing right here in London? The Thanksgiving parade, the annual one in New York City, which has just gotten underway. I've got to say, I do fundamentally miss it. You are seeing a really fun parade, a lot of the floats as well, and not to mention the band. But it is underway, and you guys should certainly tune into it because it is one of those never-miss experiences. Although I do hear, rumor has it, it is quite windy on the ground. Of course, if any of the floats get loose, we will have that coverage, I'm sure, right here on Bloomberg Television. Of course, coming with that Thanksgiving Day parade, specifically sponsored by Macy's, comes the Black Friday sales that follow tomorrow, which puts a lot of focus on the consumer for this holiday season. JCPenney CEO Mark Rosen, however, says that some of the inflation is taking a toll on that consumer, which the company has responded to by maintaining the price of holiday sale items from 2022. Rosen explaining that we still can expect a holiday season similar to previous years, even with that inflation progression. The CEO joined us this week to discuss the state of the consumer. Take a listen.
What we're seeing is half of consumers are actually saying they are going to spend more this year. I think what you are going to see is that consumers are much more focused on value than they've ever been before, and we're seeing that in shopping behavior this year.
We've had some earnings reports from folks like Burlington and TJX, which seem to show that trend certainly in place. A lot of folks trading down, and it's not just low-income consumers. You even have higher-income consumers also trading down as well. And I'm wondering whether you've actually seen that in your stores as well.
Yeah, so I think if we step back for a minute and just talk about our consumer, the consumer in our store is, we say our customer is America's diverse working families. It's a $75,000 median household income. So if you think of our customer, it's the teachers who are teaching our children, it's the medical workers who are taking care of us and our families. And for that consumer, inflation has definitely been a challenge. And so what we're seeing is the consumer is looking more for value. The consumer is more focused on price. We're seeing more responsiveness to when we're offering promotions and things like that. And, we've been really successful by doing what we're saying we're doing, which is taking inflation out of the holiday for our customers. We've gone back and taken hundreds of items that we had last year, and we're offering the same prices last year or lower. And we have thousands of gift items that are under $15 for our customer.
I'm curious as to how you're pricing this. When you say at those low prices, are those basically, I guess, the full retail price, if you will, meaning that low price, or is that the price you get to after taking into account a discount or coupon?
So I'm talking about the Black Friday price. Okay. And so our Black Friday prices are the lowest prices that we offer.
How are you going to get people, I guess, to buy? Is this about getting them physically into your store locations, or is this going to be much more of an online e-commerce strategy?
I think it's going to be a bit of both, and we've seen success across both online and in store. We launched our Black Friday early. We launched November 3rd through 5th, and we saw great success. We saw a big increase in our store traffic, and we also saw really strong buying online. If you think about the event that we're going into, tomorrow, Thanksgiving Day, will be an online day. And Friday, Black Friday morning, is going to be an in-store day. And to really encourage that in-store experience on Black Friday morning, we're going to have events going throughout the day. So we have events starting at 5 a.m., again at 9 a.m., 1 p.m., and 5 p.m. And just to give you a couple examples of what we're going to be doing, some customers will actually get $500 off a $500 purchase. In other words, we'll pay for their entire purchase. And that will be by a snap pack that they receive when they come into our store that will have coupons in it. And at 1 o'clock, we're going to be giving away diamonds. There's a diamond pendant necklace in each one of our stores, and 30,000 diamonds spread across our stores. So that's going to keep the excitement going in store throughout the day.
JCPenney CEO Mark Rosen there speaking to Bloomberg's Romaine Bostic and explaining quite the spread, I have to say, for Black Friday, but really all in the effort to keep the American consumer engaged with the selling and actually continuing to spend. But is that something you see around the world? I want to get a little bit more insight here. Bloomberg's Eric Fanner joins me right here on set. Eric, I don't know, you don't seem like the kind of guy who lines up for the Black Friday sales, are you?
I'll be in the office, unfortunately. That's right.
You're going to miss it all.
Yeah, I'll have to do it online a bit.
There you go.
Yeah, it's a bit of a different experience, obviously, in Europe, elsewhere in the world, where you don't have the physical day off for people to go in shopping. So Black Friday becomes more of a kind of a week-long, a month-long experience. Yeah. You still have promotions, but it's not as concentrated maybe as it is. You don't have that kind of retail excitement, the kind of stuff that the Penny CEO was talking about, with diamond giveaways and that kind of thing.
You don't have to like shove people as you enter the store or anything like that. So let's take this consumer conversation then region by region. Let's start in the United States, just because that's where a lot of this Black Friday pizzazz actually happens. In terms of the pricing and the inflationary kind of setback, you heard JCPenney CEO saying it right there. He's not actually changing his holiday prices from a year ago. That's pretty substantial. But then again, a year ago, that already kind of baked in a lot of the price increases. So I'm curious about your take on the inflation kind of impact on the American consumer. Is that something we should be worried about this holiday season?
Yeah, it's definitely, something that's weighing over everything. I mean, we've had, really quite pronounced inflation for the past year. That said, there are signs, obviously, that inflation is easing in recent weeks and recent months. The Walmart CEO in their recent update, I mean, they even talked a little bit about the possibility of deflation. Now, obviously, you're talking about their prices that have gone up and might start to come down. We're not really seeing that yet. So that could provide some possibility, I guess, for upside surprise if people think, well, things are going to get better after this really tough time. But I think that underlines the really cautious outlooks that you've seen from a lot of these companies in their recent earnings updates.
Well, I think what's tricky on that as well is that a lot of the price hikes that were a lot of consumer-driven companies had put out in the last couple of years, they don't exactly discount it. They don't say, you know, inflation has dropped X percent, let's bring our prices down X percent. They're very sticky prices, as are wages, which is, I think, why that is so significant. But is that the same dynamic here in Europe as well, specifically in the UK, where, of course, we had Jeremy Hunt yesterday trying to talk about decreasing the tax burden when the progress on that seems very, very limited?
No, I think that's right. I mean, one of the surprising things in Europe is that the consumer's been fairly resilient, actually, this year. I mean, you know, there was a lot of concern earlier this year, I think, about where things would go, especially in the UK, which had some of the, you know, most pronounced inflation in Europe, probably in the, you know, in the developed world. And, you know, certainly on apparel and things like that, it's actually held up fairly well. A lot of the retailers had already been aggressive on price earlier. There's a lot of competition, and you were coming out of the pandemic and all that. And so, but some of that has maybe normalized now. So I think, you know, people are pretty cautious too.
So then a final question to you. When we talk about kind of the consumption, we've talked about the United States, we've talked about Europe as well. Let's talk a little bit about Asia as well, especially with the e-commerce businesses there that thrive. You've got C Inc. or C Limited, excuse me, in Singapore. You've got Alibaba in China, of course, and not to mention all the folks there that then shop from some of the American companies as well. In terms of the global consumption story, where's the biggest hesitation?
Well, I mean, I think probably the U.S. is the biggest question. Certainly, I mean, these other regions. First of all, they're not as tied to you know, to a Black Friday event. It's more drawn out, right? So I think all eyes for the next few days certainly will be on the U.S. consumer. Everywhere else, you know, you've got a bit of a different dynamic. I mean, China, you know, there are obviously big questions there over the state of the consumer. I mean, you know, that affects luxury companies. Certainly, there's been some softening demand for the, you know, the European luxury companies that are exposed to China have flagged that. So we'll have to watch that going forward. You know, the long-term outlook there is still really positive. It's just kind of there more the midterm, you know, where that unfolds over the next year or two.
30 seconds very quickly. Do you think people will dive into luxury this holiday season? Or are diamonds and Ferraris on the European bucket list?
Except for those giveaways from pennies, I'm not sure. I mean, I think everybody's very cautious. You know, certainly even at the high end, as people have flagged. I mean, the discretionary spending, I think, is going to be, you know, interesting to watch. I mean, people will be cautious, I think.
Yeah, I feel like this is quite the litmus test to see just how resilient the economy actually is around the world. Bloomberg's Eric Fanner bringing us that global consumer story. And of course, we're going to talk about the retail industry in the next hour as well. Analyst Marshall Cohen will be joining our very own Guy Johnson and taking the conversation forward about simply whether or not the consumption story in the next 6 weeks or so actually sticks around. That's just one piece of the equation. In the meantime, you are seeing markets, again, very sanguine, limited volume trade here. Futures virtually unchanged, 45.69 on those contracts, but a bid into the bond market down about 2 basis points. Again, that's going to be pressuring the dollar, which is creating a little bit of a tailwind to those European currencies as well. Folks, to around the world, to the Americans around the world, I just want to wish you a very, very happy Thanksgiving to your family. I hope you have a very good holiday. We'll, of course, see you tomorrow, although we expect the trading to be limited then as well. And in the meantime, you'll have to enjoy the feed of the Macy's Thanksgiving Day Parade, a New York City tradition to watch it. You can see band members coming down and really pushing against what I hear is a very, very windy day in the city. Stick with us. More markets ahead. Guy Johnson takes it from here. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
This is Bloomberg.
Happy Thanksgiving. Welcome to Bloomberg Markets. The Americans are cooking turkeys, they're watching parades, but over here in Europe, there's actually quite a lot going on that we need to talk about. So let me kind of walk you around the European map. Good morning, by the way. I'm Guy Johnson. Good afternoon if you are here in Europe. There's a lot going on. There's a lot of things we need to focus on. We're going to break it down as we work our way through the show. But today you've had Turkey raising rates up to 40%. That was a much more aggressive rate hike than we anticipated from the central bank in Ankara. We've got the Swedes, the Riksbank, not raising rates. There was an expectation that the Riksbank would raise rates. They didn't. They left rates at 4%. What does that signal about what's happening in that economy? You've got an election story in the Netherlands that is really worth focusing on. So far-right candidate Geert Wilders wins the election. He's now got to figure out how to form a government, but this is a far-right government in power in Europe, at the center of Europe, one of the founding members of the European Union. What does that signal about the direction of travel? We'll break that down as well. Can he form a government? Will he become the next prime minister? You've got a few stock stories floating around. You've also got the PMI story. We'll come on to the PMIs in just a moment. There's a glass half full, there's a glass half narrative around the purchasing managers indexes. Amsterdam, the market is a little soft. We're up by a little bit, but names like ASML are certainly softer today out of the Dutch market as we get a little bit of uncertainty out of that country. Let's take a look at what's happening with the British pound. The British pound is up versus the US dollar. We're up by 0.3%. Why is the British pound trading higher today? Well, the PMI data actually came through better than anticipated, but rather than taking that as a good thing, the market seems to be viewing this as an inflationary story. So potentially the greater risk of inflation means that we won't see the rate cuts maybe that we've priced in. We'll talk about that in just a moment. Brent crude continues to soften. We're down by 1.51%. So that's another narrative we need to fold into this mix as well. So that's what's happening in Europe. As I say, busy day here in Europe. We need to break it down. Where are we going to start? We're going to start with the PMI data. So let me just give you a brief snapshot, a headline, top line of what the data are telling us this morning. So these are the flash data. This is the latest read. Euro area November composite PMI up a little bit. Actually, maybe not as bad as anticipated, rising to 47.1. The estimate there, 46.8. But as we all know, anything below 50 signals contraction. The UK data, though, PMI rising to 50.1. The estimate, 48.7 there. That's a good number. That's why the pound is rallying today. So what should we make of this data? Let's try and figure out the answer to that question. Chief European economist here at Bloomberg. Jamie Rush joins me now on set for a little bit of analysis. Jamie, there's a glass half full and a glass half sort of empty narrative around the Eurozone PMI in particular. It could be better. It could be worse. Is that kind of where we are right now? Are we stuck basically with bad data that we're worried could get worse, but actually isn't improving either?
Yeah, I think so. So when we think about the risks, what are we worried about? Are we worried about the economy bumping along at -0.1, these sorts of numbers? Or are we worried about it falling off a cliff? That's my main concern, because we're thinking that the ECB has hiked enormously. The models tell us the economy should be in a deep recession. It's not. So that's what we're looking for. And what we're seeing, actually, is that the PMIs are showing that the outlook is stabilizing. It doesn't seem to be getting much worse. If anything, slightly brighter. So I think we should actually be slightly
slightly. So you used the word slightly already about 3 times. How big is the risk that it falls off the cliff, though?
I mean, economists don't know the answer. There's you have 2 things that you know about. You know that the economy ought to be extremely weak because of the rate hikes. You know that it's displayed surprising resilience up to now. So you have to balance these 2 pieces of information. And that's why everyone's forecast looks like stagnation, not recession. It could break either way. I mean, we'll find out in the next couple of quarters. Either there will be this deep recession that the models predict, or we're going to find that we actually managed to escape it.
Why could the models be wrong? What would make why are the models not producing the result that they would normally anticipate? You would normally anticipate.
I think there's a couple of possibilities. I mean, one is that the economy was just stronger going into the hiking cycle than everyone realised. There's more scope to catch up after the pandemic, for example. Savings, as we know, were relatively high, and so it's kind of just blunted the impact of policy. The other possibility is that we're so focused on short-term interest rates that we're not paying enough attention to long-term interest rates. And when you think about where we are relative to neutral, perhaps policy isn't actually as restrictive as we think when we look at the whole yield curve in its entirety. I think QE's still there, still squeezing yields, still stimulating the economy. It's a possibility that we're looking at it through the wrong lens.
How will the ECB view this data?
Well, I think, they're basically in stasis now, right? So what is their job? Their job is to prevent markets from pricing in cuts too soon. So pretty much all the rhetoric you're hearing from ECB speakers, and we'll get quite a few of those in coming days and weeks, they're going to be pushing back on that kind of that dovish kind of market pricing.
The interpretation of the UK data today, north of 50, bit of a surprise, is that confirms that actually, again, the economy is more resilient and that we need to be more concerned about inflation. Is that the correct interpretation?
Well, I think it is certainly surprising to us. And we've got a recession in the forecast for the next couple of quarters. I mean, it was an upside surprise. It does challenge that view. So if we don't get a recession, we don't get that impact on the labour market, inflation is going to be higher for longer. What is the Bank of England's response? Well, they're not going to. I don't think they're going to hike rates further. I think much more likely is they're just going to double down on that rhetoric on how long interest rates are going to have to be where they are now.
So in all of this, recessions are sort of retrospective beasts. Do you think the Eurozone is in a recession at this point?
No, I don't think you can say that. I mean, we can, it's typical in Europe for us to describe it as 2 quarters of negative growth, right? But, I mean, when you look at the labour market, it's strong. Unemployment is still low. There's not been loads of shedding of jobs, so I don't think we can call it that.
David, great to catch up. Thank you very much indeed. Jamie Rush setting us up with the PMI data. Let's figure out what the investment case around all of this is. Ben Legler, Global Market Strategist at eToro, joins us now. Ben, the Eurozone's bumping along the bottom. What do I do with that as an investor?
Nothing for now. I think you watch and wait, you do your research, and you get ready for what's probably going to be the biggest investment call of next year, which is that big rotation out of the sort of teddy bear assets that have worked this year, big tech in the US, which probably worked for a little bit longer. But at some point next year, the closer we get to rate cuts, it's going to be looking at all these cheap, globalized laggards like Europe, like emerging markets, like real estate. So I don't think we're there yet, but, first into the slowdown, first out of the recovery, and that's going to be Europe the closer we get to the middle of next year.
Do you think the ECB goes cuts earlier than the Fed, or do you think the Fed cuts earlier than the ECB?
Great question. The ECB should probably cut before the Fed. I think they're going to be nervous about doing that for the impact it might have on the euro. But, interest rate expectations in Europe have been pulled dramatically forward. This combination of the weak economy and plunging inflation has given massive policy flexibility, I think, back to the ECB. And from an investor standpoint, that's a huge insurance policy. If I'm wrong and we get a hard landing, we get a deep recession, I think the cuts can come now. 6 months ago they couldn't come because inflation was too high. Now it can't.
Let's kind of continue along with teddy bears. At the moment, the soft landing feels like you're landing on a teddy bear. It feels like everything's going to be okay. Inflation's coming down. Central banks can cut. It's not going to get too messy. Jamie was just here a moment ago, Jamie Rush, talking about that his big risk is actually that we do see the data cratering from here, that the economic model suggests that it should crater from here, that we should get a harder landing. Does what you just described in terms of the investment case work in that scenario, Ben?
A little bit, because the Fed, or the interest rate put, is now there. The interest rate put wasn't there, 6 months ago, and markets are forward-looking. So I think, they will start to price that in. That will be a bit of a cushion on the market side. I think on the macro side, as you alluded to earlier, labor markets are still pretty strong. Inflation has fallen enough that consumers are now getting real wage increases. These are massive buffers, especially in places like the UK and the US, where the consumer just dominates the economy.
Ben, it feels wrong to be talking about Santa on Thanksgiving, but let's do it. The Santa rally has come early. Do you fade it?
Maybe a little bit. I mean, this feels a little bit like last year, right? The same thing happened last year. We had a massive November rally. We gave some of it back in December, which is the traditional strongest month of the year. And then we started off again in January. It feels a little bit like that. It gets earlier and earlier every year because everybody knows that statistically it's coming. But I think the fundamental driver here is that 2024 looks pretty good. Double-digit earnings growth, interest rate cuts coming, and investors are too cautious today, and they're allocating into that. And I think that's the real driver. That's what keeps us going.
How hard is it going to be to get people? Why are tech stocks teddy bear assets? But we'll maybe kind of dwell on that in just a moment. Firstly, how hard is it going to get to people to let go of their teddy bears? How big a challenge do you think that's really going to be? Because everybody's concentrated in this risk. I can understand why. These are big, safe stocks. That's why they're teddy bears. How hard is it going to be to let get the market to let go?
I think it's going to take some time, and rightly so. We've still got the U.S. economic slowdown to come. We just printed 5% GDP growth last quarter. That was the top, but, we've barely seen the U.S. slowdown yet. And, even the bulls, we've got 7 months to go before interest rates start being cut. So, hold on to them for a little bit longer. But I think the closer we get to those rate cuts, the more you're going to see that. And I think we saw a prelude to that last week when we had that surprise interest rate, when that surprise inflation number, what ripped your face off? Solar stocks, small caps, real estate. That is it was too early, but that I think is a prelude to what you're going to see the closer we get to those rate cuts next year.
Ben, where could you be wrong about 2024? And if you get it slightly wrong, are you going to get it kind of very wrong?
I guess I'm holding out a lot of hope for the insurance policy of these central bank puts. So where this all goes wrong, the most important number of markets is inflation. If inflation stops coming down, if God forbid it goes back up again because we have $100 oil, whatever it may be, I think that completely changes the narrative. This is dependent on inflation continuing to grind lower, being pulled down by weakening economies. If that doesn't happen, the interest rate cuts just get pushed way back, and the market is ahead of its skis here.
Ben, great to catch up. Thank you very much indeed. Ben Laidler of eToro. Great stuff. Okay, what are we going to talk about next? We're going to turn to politics. Surprise victory for the far-right candidate, Geert Wilders, in the Netherlands. He's come first in the Dutch elections. Now, he's got to form a government. Will he become prime minister is still an open question, but we're going to figure out that story next. This is Bloomberg.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Okay, let's turn to what is happening in the Netherlands. The far-right lawmaker Geert Wilders' Freedom Party claiming 37 seats in the Dutch election, and that's out of 150. Nevertheless, still a surprise, a shock even, that is resounding across Europe. For more, let's go to Amsterdam, figure out what is happening here. April Roach joins us there from our bureau. April, does he become Prime Minister now?
Yes, I mean, we can't answer that question just yet, unfortunately. The Netherlands is a coalition country, and even though Geert Wilders' party is set to become the biggest, he still needs to get a majority of 76 seats to get a majority, to be exact, if he wants to be Prime Minister. So whether he will lead the country will really much depend on whether he's able to form agreements with some of the rival political parties. And those coalition talks could take weeks or even months. We know that some of the biggest parties will start those discussions on Friday, so that's tomorrow. But it could be a while yet before we can say if he will become Prime Minister.
We've just seen some very high migration numbers coming out of the UK. The data here certainly supporting the idea that we are seeing high levels of migration. Was immigration the big issue in this election? Is that how he got elected?
That was definitely one of the key themes and one of the main topics that a lot of the parties were focusing on. It's also the issue that saw Mark Rutte collapse the government in July when the coalition failed. So it's definitely top of mind. But when you actually speak to the Dutch electorate, a lot of them actually mention the cost of living crisis, social care and housing as being part of the bigger issues. But immigration definitely plays a key role here. And you can say has been one of the driving factors that has led to Geert Wilders' party, becoming the biggest in the Netherlands.
If he does become the next Prime Minister, what is the policy impact going to be? Where is it likely most to be felt?
Yeah, I mean, for 13 years now, we've had the same ruling party in power. And Geert Wilders' party is anti-Muslim. He's spoken out against sending so much aid to Ukraine. He has tough policies, as we've just said, on cracking down on immigration. He's also Eurosceptic. His manifesto calls for a referendum on the Netherlands' participation in the European Union. Having said that, none of the other political parties want to leave Europe, so it doesn't necessarily mean that we're going to see an exit. But this is a radical shift towards the right that we're seeing in Dutch politics, which is really, potential to really transform the political landscape as we know it.
In terms of the relationship with the EU, though, where is this going to put the Netherlands? The Netherlands, a founding country. In some ways, the fact that it is a founding country and it's doing what it's doing and it's becoming more anti-European is seismic. How does this change the Netherlands' place within the European Union and its relationship with its surrounding countries?
Yes, I mean, as you said, it's quite surprising when you think about the Netherlands taking this direction, considering the fact that it has a reputation for being so open and liberal. However, with Wilders' party being the largest, a lot of these, with that critical EU stance is really going to come to the fore. Having said that, because he does need to rely on a coalition, and some of the other parties that he could potentially form a coalition with won't have such a harsh EU stance. So it really will depend on where that goes. And Wilders has been seen as softening his stance on some of his more harsher policies. So it's really one to kind of to wait and see and watch what happens with those coalition discussions.
April, what does it mean for climate policy? Air France KLM, for instance, having issues at Schiphol Airport in terms of the ability to take off and land there. Big climate pushback. The Netherlands has led in other areas of climate. Is that now going to be reversed?
Yeah, I mean, that's another one. Wilders' party has been pushing for the Netherlands to withdraw from some of its international climate agreements. And some of the other parties as well have been quite taking a bit more of a critical stance on some of the steps forwards that the Netherlands has taken. So that's definitely a key theme that people will be keeping an eye on as to, what is the constitutional feasibility as well for some of these pledges that Geert Wilders' party has been pushing for. So now we'll see what's the case of what he's put forward as a sort of electoral campaign or what will actually come forward in terms of changing policies.
April, we really appreciate everything you've done today. Continue with the great work. Thank you very much. April Roach joining us out of Amsterdam. Still ahead, Bloomberg exclusive reporting on Beijing's biggest push yet to shore up its troubled real estate sector. Details to follow. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3 as the economic picture, covering the intersections of Hollywood, Silicon Valley, and beyond.
I want to take you to the Qatari Ministry of Foreign Affairs in Doha. We're getting an announcement relating to the hostage release, which we've been anticipating. We've been waiting for the details to come through. The Qataris are now saying that the first batch of hostages will be handed over on Friday at 4 p.m. I'm assuming that's local time, Israel, 2 p.m. Here in London, 9 a.m. In New York. That looks like when the first hostages will be released. We're waiting for details on exactly how that process is then going to unfold. It looks like the Israeli-Hamas truce will then start Friday. We'll start before that, at 7 a.m. local time tomorrow morning. So 6 a.m. GMT. We'll continue to monitor what is happening, but this is the announcement that is happening as we speak, coming from the Qatari Foreign Ministry in Doha. As I say, as we get more details, as we understand exactly how this process is going to unfold, we will bring those details to you. A lot of people are following this very, very carefully. I want to turn our attention now away from what is happening in Doha to what is happening in China. Shares and bonds of Country Garden jumping quite significantly earlier on news that the distressed Chinese builder will make it onto a draft list of firms eligible for financing support. Now, authorities have been taking more forceful steps, are looking to take more forceful steps to end the nation's property crisis, which has obviously engulfed a significant number of names. The expected inclusion of Country Garden, the so-called white list, showing Beijing's pivot towards helping kind of the biggest troubled lenders effectively. Let's get some details on what is happening here, what the impact is likely to be. Sofia Horta-Acosta joins me now on set. Walk me through what's happening. What exactly are the Chinese authorities doing that they haven't done before, and why is it having such a big impact on names like Country Garden?
So the whitelist, this was important because it's an expanded whitelist. So before, Beijing was only looking at systemically important builders, and now it's really kind of expanding the list, looking at both state-backed property developers and private developers like Country Garden. Country Garden was once China's biggest developer by sales. So this is it's a well-run company. It's fallen into distress because of what's happening in the property market, not necessarily because it was over-leveraged like Evergrande. So obviously you're seeing a reaction in the shares. This is a penny stock, though. Yeah. I mean, it's also, I mean, it's valued at less than $1 Hong Kong dollar, so that's what constitutes a penny stock in Hong Kong. But it's also, there's a significant amount of short interest in the stock. So I want to see how the market opens tomorrow, see if that's kind of continued, because it is kind of a kind of pain trade in the market right now.
What kind of financing is going to be available?
That's another key question, Guy. So once you're on the whitelist, what does this look like? So our colleagues are reporting that this could come in the shape of unsecured loans, unsecured bank loans. Wow. And this is unprecedented. It hasn't happened before in China. What this essentially means is that developers like Country Garden, so if this is approved, of course, because it still has to go through approval and implementation, means that these companies can actually get bank loans without collateral like land sales.
That doesn't sound very good for the banking sector.
It doesn't. It sounds like, for example, I mean, before developers relied essentially on capital markets, on bondholders, mainly offshore bondholders, and the equity market to raise funds. So now you're shifting that responsibility to the banking sector and say, hey, you need to be in charge of basically fixing this and taking the charge on
taking the risk.
Taking the risk. And one thing, though, so what happens when bankers lend to companies in China is that the banker himself or herself takes on the personal risk if that loan goes bad. So the reporting suggests to us that actually they'll have to basically exempt that to make this work. So there's a lot of questions over the implementation of this because the risk is so high.
The ultimate objective of the Chinese authorities here is what? Is it to stabilize the financial system, or is it to get the millions of unfinished properties that are currently kind of halfway through being built finished?
I think it's both. I think the last one, so really kind of reviving sentiment, home builder sentiment, is probably the most important because that's really what will kick the recovery into gear. Right now, you're having home buyers who don't believe that projects will be finished, that even if they buy a home, that they won't get that home delivered. So fixing that problem, that's a confidence problem. That's the hardest one to fix. The funding one is perhaps easier because you could just tell banks to lend.
Yeah. At their own risk, by the sounds of things. Sofia, great stuff. Thank you very much indeed. Sofia Horta-Acosta on what's happening in China. Coming up, we are going to be talking about what is happening with the retail story in the United States. How much money are you going to be spending today? Marshall Kern's going to join us next. This is Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg.
Making his way down the west side of the park. You can see his shoes. Just going past the camera positions. The Macy's Parade, of course. It is Thanksgiving Day. It looks like I hear it's a little windy, which usually can cause some issues for some of the more larger inflatable elements of the parade. But it looks all right at the moment. It looks like they're having fun. Looks like a nice day in New York, if a little chilly. This process obviously kicks off what is going to be potentially a huge amount of spending over the next couple of days. Thanksgiving today, Black Friday tomorrow, Cyber Monday. There's a lot to think about. The US consumer has been battered in some ways by what has been happening with the inflation narrative over the last year or so. How much money is going to be spent? So let's try and find out the answer to that question. Marshall Cohen, Chief Retailer Industry Advisor over at Sakana, joins us now. Marshall, in terms of what we're going to learn over the next 24, 48 hours about the US consumer, what is it and how useful is it? Are the next few days kind of an idiosyncratic story where everybody comes out and spends, but that's kind of it? I'm trying to wonder what the signal is going to be here.
Yeah, you're asking absolutely the right question, because this is what I call a complex Christmas. This year's a little bit different with the calendar, with Christmas falling on a Monday. That gives retailers a Sunday. That's an additional weekend day of holiday as they ramp up to the big blitz at the end. But what makes this also challenging, and the reason why you're asking the right question, is the consumers telling us this year they plan on spending much later than normal. And that means that December, the latter part of December, is going to be even bigger than normal. That early part of December, starting in the next couple of days after Black Friday, Cyber Monday, we're going to go into a lull. That's going to make some retailers nervous and look like holiday isn't showing up. Black Friday will do well. The deals have been plentiful, but the challenge for Black Friday this year has been the sales have been going on since, you could almost say for some retailers, mid-October, certainly since November 1st.
The US consumer is pivotal to the US economy. We continue to be confounded by the strength of the US consumer. What is your, and I know this is a kind of multi-layered question, but what is your current assessment of that strength?
Don't ever sell the resilience of the American consumer short. It is amazing how even in recession years, 2008 and 9, the consumer managed to find ways to spend and make sure that their kids had gifts. This year is a little bit different. It doesn't mean that they're not going to find ways to spend, but they've already maxed out credit cards to some degree. We've got record debt on the credit card levels. We've also got some of the student loan payments that started to come due on October 1st. We've got several people with kids that have to start paying back those student loans if they've decided to do that. And then you've got just the absence of new and exciting merchandise in the mix. So this is a holiday where the consumer's basically saying, if I really don't need that item, well, maybe we can put it off. But they're going to make sure they give gifts. Their kids are still going to have toys under the tree. But it's really going to look a little bit different than what we've normally seen. So the consumer will spend. Remember, we've got inflation built in there. We've got a higher cost for the meal, and even Thanksgiving dinner is costing more again this year. So that's going to erode some spending power from a unit perspective.
In terms of where the priorities lie, is it stuff? Is it food? Is it travel? How do you sequence out where retail fits into the kind of the bigger services side economy?
Frequency really, discretionary product versus frequency product, or, the consumers clearly prioritized. And when we look at where they're telling us they're going to be spending, well, they are going to do some experiences. They certainly are going to basically go out and say, we're going to eat and get the essentials first, and then the discretionary product next. So the areas that are feeling the pain more so this holiday are the general merchandise areas. Food is still doing well from a growth perspective, not as well as it's been doing. Even units have been declining at a greater rate than the dollar has created growth. But from a general merchandise perspective, from a gifting perspective, and even more important, from a self-gifting perspective, holiday, a lot of times when we would buy for someone else, we would buy for ourselves. This year, that's missing from the equation. So when you take out new and exciting product, you take out the sense of urgency, and you take out the self-gifting, growth is going to be very hard to come by for the overall holiday market.
Marshall, you have a great Thanksgiving. Thanks for stopping by to see us. We really appreciate it. Enjoy the rest of the day. Marshall Cohen, Sakana, Chief Retail Industry Advisor. Thank you very much indeed. Now, here's another question. Are turkeys going to be safer this Thanksgiving because of a new product from Novo Nordisk? I'm talking, of course, about Ozempic and Wegovy, two products. Blockbuster weight loss and diabetes drug that have an impact on diets. Are the turkeys going to be safe as a result of that? Let's bring in Sam Fazeli from Bloomberg Intelligence for more on this. Safer turkeys?
I never thought I'd get this question ever in my life.
That's what I'm here for.
Safe for turkeys. Let's put it this way. 1% of the population that currently the drugs are approved for are taking it.
Yep.
So I don't think we need to do much more than that. You've got the maths already. Yep. I don't think it's going to save too many turkeys. And in any case, what they'll do is they'll still cook them, hopefully not with a deep fryer.
Yeah.
And then just not eat it as much, or keep it for the whatever it is they do in the US. If they do what they do in the UK, curry, sandwich, pie.
Yep.
That
Talking
comes
my
on
book
afterwards.
now.
Yeah. So that's I don't think the turkeys are going to be saved that easily this year.
Is this, though, a trend over the next few years? The numbers, as you suggest at the moment, are relatively small. And the reason for that is that Novo's having sort of issues with production. But that production problem will be solved. We'll talk about that in just a moment.
Yeah. It's not issues. It's just the demand is so high that they can never.
They can't produce enough.
But it is So I don't think you're going to be necessarily looking at things changing seismically in the next very close few years, like next year or the year after. Not because of manufacturing, but also because of it's going to take time for people to take more, for more people to get on it. Come 2028, 2029, 2030, when they become cheaper, when they go generic, and you've got orals, suddenly that becomes a reality that maybe 10, 20% of people are on it.
At the moment, they're not orals. They are, you've got to inject.
Once a week.
And one of the big steps forward that Novo Nordisk has been made in France today. So I understand the French president has visited this new facility that Novo is going to be producing at. Just walk me through what this French facility is going to be doing. How big is it? Is it a game changer? What's the maths here?
It'll be, with that sort of investment, it'll be enough to make a meaningful dent in the required manufacturing capacity. But let's not forget, these things take a while to come on stream. And I suspect that it's in France because they did some kind of deal as opposed to it being in Germany or in Denmark or elsewhere.
Subsidies.
Exactly. So, and who gave the most subsidies? I think you already know the answer there, because they got it in France. Yeah. So, I think you're not going to see this really impact in 2024. I mean, that would be really amazing if they managed to do that.
It would be remiss of me to let you go without asking the question about what's happening in northern China. So we're hearing reports of a new respiratory disease, potentially amongst younger people. What do we know?
Is it new? I mean, you remember, as our great reporting has already said, this time last year, China was locked down.
Yep.
So this rapid rise, and remember, when you get locked down, everybody was worried about more flu, more infection. This is the bacterial infection of the lungs, the one that gives you weeks of hacking cough. And I don't know if it's anything different apart from simply much more contact and lack of immunity from the past, and basically just a rebound, if you like.
We know you'll be keeping an eye on it, though. Sam Fazeli, Bloomberg Intelligence, as ever, thank you very much indeed. Coming up, the decision by OPEC Plus to delay its upcoming meeting, dragging crude markets lower. What's happening? What's going to happen next? We're going to find out. This is Bloomberg.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Bit of breaking news over the last few minutes out of Germany. So it's a convoluted story, but bear with me. It's important to get your arms around what is happening here. So we think now there is going to be an announcement at the top of the next hour, 4 p.m. in Berlin, 20 minutes time, 18 minutes time. And that announcement is going to be that Germany is going to suspend its constitutional limit the debt brake on new borrowing. Now, that's going to be for a fourth consecutive year. It's only going to be for 2023, and it's going to get complicated. So here to uncomplicate it is Bloomberg's Chad Thomas. So firstly, what do we get at the top of the hour?
What we're going to hear at the top of the hour is from the finance minister, Christian Lindner, and he's going to say that they're going to allow this emergency borrowing to take place for 2023. So this year's almost over, right?
Yep.
And after this court ruling, this constitutional court ruling...
Just explain the court ruling for a second. So basically, a few days ago, the Constitutional Court in Karlsruhe said there's this big pot of money over here. It's not real money, but they were borrowing.
Exactly.
It was authorization to borrow. You're not allowed to use that because that was emergency pandemic funds.
Germany created a whole bunch of special funds, and they used those special funds to go around the regular budget to borrow money. And the Constitutional Court said, you can't do that. That is not constitutional. Now they're trying to come up with a plan for how do they fund all these things, the climate transition, the efforts to the military, all these new things. So it's a small piece of the solution that they're going to announce at the top of the hour. It's $37 billion to plug the budget gap in 2023. We don't know what they're going to do for 2024. And these special funds, they haven't done anything for that. This is just to say we now have a shortfall of $37 billion because of this court ruling in 2023. We're going to borrow that money to plug that gap.
But the courts presumably are going to have another look at this. This is, you're not allowed to get rid of the debt brake unless it's an emergency. Is this an emergency? It probably is for the German government, but is it in reality from a Karlsruhe point of view?
That is the real question, and we invariably are likely to see more lawsuits. Of course, the reason why this all started is there was a lawsuit from the opposition Christian Democrats. That's the party that Chancellor Merkel used to be a part of. They're now in the opposition. They were the ones who challenged what the government was doing. So maybe they let this go through, but this is also why they're only going to suspend this debt brake and allow this added borrowing for just 2023 for the rest of this year, because they know that there will likely be court challenges, and the more you try to say this is an emergency and it's emergency going out 5 years into the future, the higher likelihood the court's going to say no.
There are some in America that will be watching this right now thinking, this sounds awfully like a government shutdown. Is there any similarity between what happens in DC and is now what's happening in Berlin? And is this going to be an ongoing problem that bond markets are going to have to worry about, think about?
So we're not on the edge of a classic U.S. government shutdown at this point, because the government still has money, and they don't need to authorize more money as such at this moment. But they don't have a budget for next year yet. So if they're unable to come to an agreement within this coalition on a new budget, you're going to be facing that cliff edge, say, come the end of the year. Now, the coalition says that they are working on a revised budget, and they have every intention of getting that done before the end of the year. I mean, the difference here is that you have the chancellor is part of the coalition, right? You have a parliamentary system there. So if they can agree within the coalition, then they move forward and it goes through the Bundestag. But you have three parties in the coalition who don't always agree.
And you have down the road Karlsruhe, who can make things difficult at a moment's notice.
Absolutely.
Chad, great to see you. Thanks very much indeed for stopping by to explain what is happening over in Germany. It gets more convoluted by the moment. Chad Thomas, Bloomberg's managing editor for Western Europe. Let's turn attention to what is happening now in Qatar and Israel. Qatar saying a short truce in the war between Israel and Hamas now will begin on Friday morning. Now that's a day later than initially anticipated. We now anticipate as well that we're going to see the hostage release starting at around 4 p.m., we think, local time as well. Bloomberg's Ona Ant joins us now from Istanbul following this story for us. Ona, how many details do we actually have? I saw a couple of headlines a while ago, but just walk us through what we now know.
Sure. After the delay that we now know about to the deal between Israel and Hamas, Qatar has just announced that the truce between the two warring parties begins at 7 a.m. local time, and about 10-11 hours later, the first batch of Israeli hostages will be released to probably the Red Cross in the Gaza Strip, after which Israel will also release Palestinians, both women and people under the age of 19, that are currently in Israeli prisons. Now, unlike what we knew before today's announcements by Qatar, which is a main mediator in this conflict and truce deal, it looks like the release of Israeli hostages will take place in basically 4 batches along the truce, the 4-day-long truce. That's what the Qataris and Israeli Defense Ministry have just said basically over the last few minutes.
Ona, is there any expectation that we could see more hostages being released, that this program could run for extra days? The idea being that we also get extra days of truce as well.
Well, that idea has already been built into the current truce agreement. So if after the release of 50 Israeli hostages, Hamas decides to release or agrees to releasing more, for 10 hostages, it gets another day of extension to the truce. So that idea is also already there, and obviously it was one of the main driving forces when Qatar and others mediated this deal, because they're hoping to basically create some time for diplomacy to work, right? Israel wasn't really looking at this idea of a ceasefire very warmly just until a couple of weeks ago, but now that they have this deal, they're hoping that the mediators are hoping that they can work something out of it, and by giving diplomacy more time. Now, as things stand now, that the chances for that kind of longer-term cessation of hostilities looks a bit slim, but that's what the mediators are definitely hoping for. And yes, the key to that would be for Hamas to release more hostages every day and get an extension, and that gives more time to diplomats and mediators to basically work something out for the longer term.
Ona, thank you very much indeed for updating us. We will be following this story with a great deal of interest, so more details we hope will now follow. Bloomberg's Ona Rand. Let's turn our attention to what is happening with the OPEC story. So oil very volatile over the last 24 hours. OPEC saying that the meeting we thought was going to be happening this weekend will now be held online on November the 30th after we did see this delay. Now, what's going on behind the scenes, I think, is absolutely critical here. Will Kennedy joins us now from Bloomberg News' senior executive editor covering energy and commodities. Well, when I spoke to you yesterday, you were trying to figure out what was happening. What were the Saudis after? What was going on in terms of the communication between the Saudis and the rest of OPEC+? What do we now know 24 hours later?
Well, it seems clear that one of the major sticking points is this issue with 2 of the African members, Angola and Nigeria. Under agreement they made earlier in the year, those countries, a group of African countries, agreed to have their quota reassessed and based on current production and capacity independently verified by some oil and gas agencies. That process appears to have happened, and the African countries haven't liked the result and are balking at what it's asking of them. And it seemed that became such of a problem that it was easier just to delay the meeting again a little bit to resolve it, and that's why it's happening next week. Quite where that dispute is and how bad the problem are is not entirely clear. There was some chatter that it might even involve Angola leaving OPEC. The Angolans went onto the record to say, no, it's not that bad. Yeah. So that's it. I mean, it seems like a bit of an impasse, but you know, the chances are that they'll probably work something out before next week.
The concern was that if the Saudis didn't get what they want, they would basically pull back on their unilateral decision to cap their production. How big a risk is that?
We don't know, and I think we won't know exactly how this plays out until we get to the end of the process next week. If you look at the market reaction, we did have a big sell-off yesterday and a little bit more today, but Brent is still holding above $80 a barrel, and I think that tells you that the market expects a resolution that doesn't take us too far away from where we are now, i.e. it's not the main expectation that this leads to Saudi Arabia putting more oil in the market. I think most people expect that Saudi Arabia wants to continue with the current policy, wants to keep supply under control and keep prices more or less where they are now or higher, but it just wants more help perhaps in doing that.
Great stuff, Will. Thank you very much indeed. Bloomberg's Will Kennedy. What's happening in the oil market? We're going to be tracking this story very carefully. More details, I expect, will emerge as we work our way to that online virtual OPEC meeting. This is Bloomberg.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Three, two, one. Asha! I'm here. Whew, just 1 second. Let me catch my breath.
Wish, Disney's latest animated film, meant to be big this weekend. Apparently it may not be. Some are even talking about it bombing at the box office, which would be embarrassing. But its performance may just be a sign of the times, actually, in so many ways. Thanksgiving used to be a massive weekend for movies. It has become less and less important. 3 Men and a Baby, other classics all came out around this time of the year and did really well. Not so much anymore. Bloomberg Quick Take correspondent Alex Webb has been following this story very carefully. This is the main event of the weekend, but it's not. Why is this bombing? Why is this not going to go down well?
I'm sorry, I'm gonna say it. Careful what you wish for, right?
I knew you'd be working on things like this.
It's a threefold problem. It seems to be. Firstly, film doesn't seem to be very good. The Rotten Tomatoes gives it 47%. Clearly not very strong. Yeah, exactly. Yes. Secondly, you're coming out of the back of this actors' strike, which means that the actors have not been able to promote the movie. You'd often have the full Disney kind of apparatus rolling up, going on all the chat shows promoting this thing. That has not happened. But thirdly, and this is the kind of more structural issue, is have they, by pushing people towards streaming platforms for the past 2-3 years, kind of programmed the audience to see, well, why should I bother?
Wait. All these movies come out now. You give them 2 weeks, maybe a bit longer, and you've got them on one of the main platforms.
Exactly, and this is the whole push from Disney over much of the past 2-3 years was double down on Disney Plus, become a growth stock. As you saw as interest rates increase and people not stuck at home quite as much, that story changed. They're now